So let us start with revision of a very big area in FM, capital budgeting. With regard to this chapter, capital budgeting, so the area we are going to start is capital budgeting. With regard to the capital budgeting chapter, we are going to make a super quick revision. This area will be coming for 8 marks in examination. First, let me tell you what are all the concepts that are relevant in this particular chapter. Okay, first one, you need to learn these areas. First, understanding what is a cash flow is the primary requirement of this chapter. Second one is, after understanding what is a cash flow, second one you should understand there are some techniques in capital budgeting in this 2 parts. Non-discounting, discounting. Non-discounting means without discounting factor, those techniques will work. In that again 2. One is payback period. Second one is ARR. ARR means accounting rate of return, also called as average rate of return. Okay, what is the meaning of ARR? Not full form, meaning தெரியாது. சரி, next. Discounting payback period. Discounting techniques. Discounted payback period with discounting. And next concept is NPV. Next one, IRR. Next one, profitability index. Profitability index. And next one, EAB and EAC. EAB and EAC. These are the discounting techniques. In examination, 99% every attempt, question will come from any of these. Okay? Why 99? What is that 1%? That 1% chance is capital rationing. Okay, capital rationing. This also can come in exam. This is not a technique. This is a concept. Concept is different. Technique is different. Technique is to evaluate. Concept is to understand. Understood the point clearly? So, capital rationing is not a technique. It's a concept of putting the capital in multiple places. Okay? But these are all techniques. So how to use all these techniques is the subject matter of this particular chapter. Clear everyone? Okay. Let us understand one by one the topic. Asal, what is this ARR? What is this payback period? What is this discounted payback? What is NPV? What is IRR? What is a profitability index? And what is the concept of EAB and EAC? Shall we begin? Those are all the areas we are going to start with. Just a minute. So those in live, voice is now audible. Okay. So these are all the techniques that we are going to see in this particular chapter, techniques and concepts. Okay. What are all the techniques and concepts? Let us try to understand clearly. What is a cash flow? First we need to understand what is a cash flow. Next one, techniques in capital budgeting. There are some techniques in capital budgeting. Non-discounting techniques, discounting techniques. Non-discounted techniques are payback period and ARR. Next one, discounted payback period discounted, NPV, IRR, profitability index, EAB and EAC. EAB and EAC. So these are all coming under the discounted techniques. These two are non-discounted techniques. Okay. First, let us understand as to what is this concept of cash flow. One by one I will go. Please listen. Capital budgeting normally will take 53 hours for me to complete the chapter. That we need to cover in 1.5 to 2 hours means I will tell all the key points of capital budgeting chapter. Are you listening? What is most important for the examination? Okay. Problems also we will solve. But I will tell what are all the key points that one has to observe. First, ARR. What is this ARR? ARR is the worst way of analyzing any project. Worst way of? Why do you know? Because ARR do not consider cash flow. ARR consider profits. ARR consider profits. ARR do not consider. Always project analysis means you should consider cash flows only, not the profits. Normal class I will tell the logic also why it is so. But now it's the time is not there. Just I will explain this way. Profit contains lot of non-cash items, unrealistic items. So many things will go into the profits. Because profit for one person and profit for another person may not be same. Profit will change from person to person because reason. FIFO if you value stock, one gross profit will come. LIFO if you value, one gross profit will come. Weighted average if you value, one gross profit will come. And a person to person, because of taking a accounting policy, profits are changing. I will take 2% bad debt, you will take 3% provision for bad debt, she will take 5% provision for bad debt. Bad debt, no one will know how much will come. It's an estimate, accounting estimate. So because of that accounting estimate, what will happen? You will get one profit, you will get one profit, I will get another profit. Profits also are not same across any person. Are you listening? Yes, next important thing. Along with that, for example, life of a asset. Life of a asset. For example, I say computer. For example, camera. Camera is there. I said, life of this camera will be 2 years. Or life of this camera will be 5 years. If I use SLM, I will divide it by 5. Cost of camera 2 lakh divided by 5, 40,000 every year. Correct? He assumed that I will use it for only 2 hours in a day. It will come 10 years for me. Then his depreciation will be 20,000 per year. Listening? She thought that I will use camera for almost around 14 hours in a day. It will get depreciated very soon. Then she will tell usage life is only 3 years. Then 2 lakh divided by 3. Now depreciation for me, depreciation for you, and depreciation for her. Same or different? What is this nonsense? Concept is same, company is same, sales is same, purchases are same, but why profits are changing? Hey, see, company sales is same. For example, sales for me 1 lakh mean sales for you will not become 2 lakh because sales already made. Correct? For you sales are same, for me sales are same. Purchases same, opening stock same. And the valuation may change, but the number of goods are same, na? Answer, yeah? Then how come you will get one profit, I will get another profit? Ante, profits are disturbed not because of the main items, because of accounting policy, accounting assumptions, accounting estimates. This is spoiling the profits. Therefore, FM is a practical subject. Practical means not problematic. Practical means it will run on a practical level. It won't take unnecessary nonsense into consideration. Because with accountancy, a fool only will take decisions. Accountancy is not for decision making. Accountancy is for reporting the result. Reporting the result. Decision making will be done only through financial management. Financial management is used to take decision making. Accountancy is no decision making, nothing. Already taken decisions are reported there. That's why accountancy and audit is a post-mortem. Financial management is a pre-mortem. Even before happening, we will understand everything. Understood the point, everyone? So that's why always in financial management, discounting factor will be taken. Discounting factor means what? Present value of future cash flows. And the future what is going to happen, we will predict today itself. Listening? So financial management is a futuristic in nature, accountancy is a past in nature, Financial management la past is called as a sunk. Understood? Those are called as a sunk transactions. Even in costing you will find this word. Sunk cost they call. Sunk cost means cost which is already incurred. You can't do anything for that. Those are called as sunk cost. There is no relevance for that in decision making. Clear? So now why I am telling this is, listen. Cash flow means how to calculate. See the screen. See the screen. I will not go very deep and explain every point because normal class la cash flow concept will take around 2 hours time. But I have to explain that in 2 minutes to you. So please listen carefully. What happens is, I will be given with sales minus cost. I will be getting EBIT. A variable fixed I am not showing. Sales minus cost. What is it? EBIT. Minus interest. Minus problem comes like this. What is this? Minus what is this? Minus depreciation is also there. What is also there here? Depreciation is also there. Understood? Now what will happen? This will become EBIT. Minus what is deducted? Interest. What will come? Minus what will be deducted? Next one, what will be added? What will become? EAT. What will become? Let us say interest is also not there. Tell the income statement. Sales minus operating expenses which are cash in nature, we call EBDIT. Earnings before depreciation, interest and tax. From this, depreciation. EBIT. From this, interest. EBT. From this, tax. EAT. Understood? Now tell me, what is this? Cash or non-cash? Loudly. Really you will spend this amount or will not spend this amount? But this amount will be useful for one purpose. Tax saving. What saving? To understand this, I have one good example for you. See. Fast. Sales 5 lakh. Two projects. 5 lakh. Production cost 3 lakh. EBDIT 2 lakh. Depreciation 1 lakh 80,000. Are you listening? 1 point depreciation 1 lakh. Another side 80,000. EBT 1 lakh 20. Tax 30%. EAT 70,000, 84,000. Tell me, who is giving more profit? Project A na project B na? See, they didn't tell ya answer. Project B. But this is after considering depreciation or before considering depreciation? After considering depreciation. Understood everyone? But this is wrong. Like this you should not analyze. Because depreciation is really spent, really not spent. Answer. Then why you are reducing it? I will reduce for tax saving. But you have to again add back. What you have to do? Because it is really there or not there? Not there. See here. Sir, under depreciation required a waste? Waste. Therefore, since it is waste, I will do this way. See the screen once. Completely ignore depreciation. Sales. Production cost, EBT, tax, EAT. Now both are equally good. Both are. This is also wrong. Why this is wrong? You did not consider depreciation at all. Means whenever depreciation is given, how to do? Deduct depreciation first. Listening? Next, lastly, what you have to do? Depreciation has to be added back to arrive at cash flows. Listening? One observation for all the students. Listening live, listening face to face, everyone. Listen to one point. See. So listen carefully. Up to here everyone understood clearly, yeah? Up to here, everyone understood clearly? 1 minute. So let us continue. See here. So sales expenses, EBITDA, depreciation deducted. Depreciation will be deducted and finally it will be added back such that we will get what advantage? Tax savings. I will tell you the meaning. See here. See here. This is right way of decision making, a wrong way of decision making. Wrong way. Why this is a wrong way of taking a decision? Because here you are taking profits or cash flows. Answer. Which is not the way of taking a decision. Okay? We should take decision on the basis of what? Cash flows, not on the basis of profits. Okay? This way is wrong. Therefore, what we have to do, see the screen. Sales, cost, EBITDA, depreciation deducted? Yes, deducted. EBT came, tax came, EAT came. Again, what I have done? Added back depreciation. Suddenly, which is good, now became bad. Suddenly, this project became more favorable project. Are you listening? Yes, sir, instead of adding it, instead of deducting, I will totally ignore. You should not totally ignore. Do you know why? See the screen. Idenna? How much? 1 lakh. How much? 1 lakh. Your earning is 2 lakh. Your earning is 2 lakh. You are reducing depreciation and became 1 lakh. On this 1 lakh only you are paying the tax. Correct or not? If you do not consider depreciation at all, you will pay tax on 2 lakh. Correct or not? Do you know what is the meaning here? Under section 32 of Income Tax Act, under section depreciation is a deductible expenditure. Though it is a non-cash item, income tax also allows you to take depreciation. Are you understanding? And depreciation is a deductible expenditure or non-deductible expenditure? Happily you can deduct. And for the real income tax purposes also, depreciation is a deductible expense or not? If you totally do not consider, it is wrong as per Income Tax Act also. So what we need to do first? Deduct depreciation, get the tax saving, and again what to do? Add back such that net of tax saving, depreciation advantage you will take. Are you understanding or not? Okay. So this is the point here. So always tell me how to calculate cash flow. Forget about interest. Tell the remaining. Sales minus operating expenses minus depreciation is called as EBIT. Interest will not be there directly. EBIT will become EBT minus tax, EAT plus depreciation. Resultant will be cash flow. One observation to everyone. Nowhere in capital budgeting chapter, I repeat, nowhere in capital budgeting chapter you will find interest. Show me one question. Show me one question in study material where interest is there. It will not be. Guess why? Students in live also can answer this question. People who think that we understood FM should answer this. Those in live, my voice is audible? Now tell me, why interest is not considered anywhere in the questions? Students in face-to-face can answer first. No. Guess the answer? Let us see anyone in live answered the query. Voice is too low. What to do? These people are not there here. Now is it okay? Voice is clear now? Students in live? Now it is okay? Now, tell me now, everyone. See here, always in capital budgeting, we will never consider the interest cost. Okay? We'll never ever consider the interest cost. Normally, EBIT minus immediate next item will become interest. Flow we will also deduct interest and we will calculate, correct? But nowhere in capital budgeting you will take. There are so many reasons for that. I will take 2 hours explaining this concept itself. But that much time is not there for us. But why I am discussing now? 2 reasons. So many people think that they learnt FM, but they learn nonsense beyond FM. That's point number 1, where they will feel difficult at CA final level because of that. And second very important thing is, why we need to learn about this is, flawless student will do mistakes. Because of this, I will tell you what they will do. Intentionally, institute will give questions in examination where interest rate also will be given. Then what student will do? Obviously, consider interest rate, first deduct interest cost. Depreciation again add back, but at the end of the day, your cash flow answer will go wrong. Correct or not? Normally, leverages chapter interest will be reduced. Capital structure chapter interest rate is reduced. Flow capital budgeting also they will reduce interest. Eventually, the answers will go wrong. Why we should not do? Do you know why? Listen. Let us say we are calculating NPV. We are calculating NPV. NPV, some standard columns are there. Year, cash flow, PV at the rate of some percent, 10%, PV, CF. Are you listening? Okay. Year, cash flows, PV, PV, CF. Correct? Huh? Answer. What is this? What is this? This is called as cost of capital. This is called as what? Entire cost of capital chapter, what we do is, we calculate appropriate PV factor. Hello? Tell me, my company has equity and debt. I will calculate KE, KD, KO na. KO. KO means overall cost of capital, weighted average cost of capital. Listening? Okay? Tell me, in this KO, KE is there, KD is there. KD means nothing but interest. Already discounting factor interest is there. Understood? If you again reduce interest, cash, already this cash flows, interest is there. Listening? That is already considered in this PV. When you discount, effect is given. If you again reduce the double time you are considering interest, answers will go wrong. Understood or not? It is simple way, 1 minute completion. Regular classes you see what I say, same concept, 2 hours we will discuss, because I will go into the background there. Asal why this concept came like this, asal how interest cost had to be understood. See, I will give you a simple example. A car is going. A car is going. Okay? See, understand with the common sense. A car is going. He came to me. We are standing, car is moving like this. I asked him, is this car good or not? I asked him, is this car good or not to purchase? I wanted to purchase this car. Is this good or not? I asked. What could be your answer now? For example, if I ask, how is this car? Can I buy this? What should be your answer? Either you will tell, good one, buy. Or bad one, don't buy. Or moderate, something you will tell, correct? Which fool in the world will tell, if you take loan and buy good, if you purchase out of your own money, bad? Who asked about financing? Understood or not? I am asking about which decision? Investment decision. When I am asking about investment decision, why you are bringing financing decision into that? That's why name of this chapter is investment decisions in study material. Not capital budgeting. Capital budgeting, I call it capital budgeting. Are you understanding or not? After me calling it capital budgeting hundreds of times, it became popular also. Capital budgeting, people will call in the same way, because in final they call capital budgeting. But in CA Inter they don't call it capital budgeting, they call investment decisions. When you are taking investment decision, Your financing decision should not color that. That should not affect your decision making. Listening, huh? I will give you an example. See, sales 100. Sales 100. Direct expenses 50. Direct expenses 50. Depreciation 20. EBIT will be 30. Correct? EBIT will be 30. Minus interest 50 rupees. Or interest is 60. Huge amount of interest I am paying. And the company is running fully with debt. Running fully with debt. Therefore, lot of interest cost will be there or not? 60 rupees interest is there. Are you listening? Because of this, tell me now. EBT, how much? Minus 30, correct? Minus tax, nothing is there. No refunds will come. Tax will not be there. Are you understanding? Next, after that, what is it? EAT, 30 plus what? Depreciation, how much? 20. So, cash flow will become minus 10. Cash flow will become? Okay. I will give another example now. Let's change. Interest is 40. Interest is 40. Then EBT will become how much? Minus 10. EAT will become how much? Minus 10. Plus 1, how much it will become? 10. Correct? Answer, sir? Now, listen. 10 rupee is my profit. Correct? Here, how much is the loss? 10 is the loss. 10 is the? No, cash flow, negative cash flow. Loss means I mean negative cash flow. How much is the negative cash flow? Answer. 10 negative cash flow because of considering what? I am asking, can we purchase this machinery? When I ask you, can I purchase this machinery? Why interest is deciding my decision making? Are you understanding the point or not? Interest is ruining this project actually. If you remove interest component and see entirely, it is a super project, yeah. See, without interest you tell. Sales, direct expenses 50, depreciation 20, EBIT 30. Tax will not, interest will not be there, na? Tax, let us say 10% tax or 30% tax. How much will be deducted? 9. Now tell me EAT directly. Hare, this is a super project, yeah. Project only you see, forget about the financing model. Are you listening? Forget financing and see only the project. Is project a good project or not? Yes. Later you think, see, project itself is giving negative, then don't consider that project. Understood or not? Project is giving positive. Because of whom it is becoming negative? That is a capital structure decision. That is a financing decision. Then don't finance by debt. Go for public offer. Then that interest will not be there. Na? Why to cancel the project altogether? Just because of this interest. Understood the point or not? When project is good, do it in some way possible. Just because of the reason that interest cost is making it, if interest cost is making negative, go for equity. Equity shares anyway, dividend is not compulsory, na? That means that interest will become 0 or not. Super project it is. From this 21 rupees you distribute dividend. Like this our attitude should be. Understood? With this logic, steady material concept is also there. We don't read, that's a problem. Clearly he has said. Hey. Institute is not doing mistakes. They are very clear about what they are saying. Good material they have given, we will do all nonsense. Sir, anyway, understood the logic clearly, yeah? That's the reason why we don't consider interest into the capital budgeting chapter. Capital budgeting is which decision? Just now I said you forgot. Capital budgeting is which decision? Into that what should not come? Financing decision should not disturb them. Project A negative cash flows, I'll forget about it, don't take up. Take or not to take? Not to take. Project is giving positive, becoming negative because of interest, go for alternative cost, alternative financing. Don't go for debt, go for preference. Don't go for preference, go for equity public offer. Don't go for public offer, go for commercial paper. Not possible, go for deposits. So many ways are there. Just because of interest, why you are going back? Don't step back like that. Understood or not? If something is good in terms of returns, some or the other way do it. Financing, we can see later. Money will come. But do the investment in a proper way. That's the logic behind this concept. That's why even in the examination, if there is any interest percent given in the question, that interest percent should be used or not to be used? Should be used for PV factor only, not for interest deductions. Understood the point or not? Those in live, answer this. Everyone understood? Okay, see, but I can tell you one thing. FM means I will get kick only if I teach from the beginning till the end. But that much time I was not allotted, that much time I can't take revision class also. So I am covering idea behind this. You understood the concept? Same thing in normal class I will take 3 examples. Okay, 2 hours I will explain this by different examples. Like this if it comes, like this if it comes, like this if it, 3 situations I will take. But that much I can't do now. But idea you understood now clearly what to do? Answer. So idea is very clear. Capital budgeting chapter, interest rate use only for PV factor, not for interest rate reduction in income statement calculation. Reason I told you why. Clear? This is the idea. Yeah. Next, depreciation is one very important adjustment. In some questions, they will give 2 depreciations. One, depreciation rate followed by company. Depreciation rate as per Income Tax Act. Very important adjustment. How to tackle? How to tackle? Do you understand what I said? Depreciation for company. Say, companies act depreciation, income tax depreciation rate, both are same or different? Different. Both are not same. And company depreciation followed and the income tax depreciation allowed, both are same or different? Different. Both are given in the question. What you will do? Both are given. What you will do? Those in live. Live students, you are inactive, you are not actively answering. See, no. Listen, whenever question is given and depreciation of both are given in the question, both means what? As per income tax given, as per Companies Act also given. As per income tax given, Companies Act also given. See, I will show you a question and I will show the answer. Clarity. Rather than telling something in air, I will show you the question. I exactly didn't remember the question number, but it is there. Question number. See, let me see the answer directly, then I will remember. Yes, this is a question. Question number 18 here. Illustration 18. Illustration 18. Ida question. Okay. See, company follow SLM. Company follow, but income tax follow WDV with 7.5. Both are given in the question. I'm talking to you. What to do, how to tackle this problem. Okay, this is question. So old machine, new machine, details are given. In this question, you will learn two important points. Number one, tell me, whenever old new are given, why? What is the purpose of the data? Tell me. Capital budgeting chapter la old machine, new machine data is given. No. Why they will give data of two machines? You are very poor in capital budgeting. Yeah, this is not expected of you. Finally, you will suffer a lot. 20 marks capital budgeting final. What is the purpose? You are not even telling the basics. Those in live, these people are yes sir, yes sir. One person has given right answer. Very good, Varshini. Appreciated. See, why two machine data is required? See, always capital budgeting means people understand we will buy something, decision will be taken. Correct? That is general mindset. We will buy a machinery. For buying the machinery, we need to budget that. How much revenues it will, cost benefit analysis. Listening? How much cost we are putting, how much benefit we are getting. We will compare both of them and take a decision finally. It is generally student will know. But only an expert will understand what really capital budgeting wanted to convey. See, capital budgeting la always new machine purchase is not the motive. Sometimes there is a process. There is a process. X, Y, Z is a machinery. Okay, va? X, Y, Z is a machinery. X will process, send to Y. Y will process, send to Z. Z will give the output finished goods. Okay. X good machine. Z is also good machine. Y is the bottleneck. Y is the idanna. What is this? Neck. Do you know what is a bottleneck? Bottleneck is called as a problem. Bottleneck is always a problem. See, bottleneck is like this. I will reduce the size of the neck. Okay? Water flow will increase or decrease. Again I will make much low. Small nozzle. What will happen? Flow will be decrease. Lastly I will make as a pen refill. Water will stop coming from that. Correct or not? Always what is important in a production process is not the body of the process, the bottleneck is important. Are you understanding the point or not? Which machine is bottleneck in the entire process? That identification first person should know. Are you listening? In your studies also CA, when you are studying inter, subjects when you like something, just like that fatafat you will complete the chapter. Some bottleneck subjects will be there. If you sit there 4 hours you will put the book, you will not understand anything. For me audit. Are you understanding? Like that, that's a bottleneck for me. Whenever bottlenecks are there, bottlenecks will slow down the process. Bottlenecks will slow down the process. The entire, we will have a momentum. That momentum will suddenly stop because of this bottleneck. Listening? I will, bottle is there, I will open this. After that if I put like this, speed will not be good because the size is very small here. If bottle body and bottleneck are of same size, if you pour enough fat, water will come out. Correct? Like this bottle. Do you understand my point or not? What is stopping the flow? Bottleneck. Same. In companies also, I don't wanted to substitute entire machine. I wanted to substitute one of the machines out of all. One of the, see, common sense let us use. Machine 1, machine 2, machine 3 gives what? Hey, answer, yeah. Finished goods. Okay. Now, finished goods will be sold. You will get revenue. Our revenue lo inche cost, EBIT, EBT, EAT, everyone will eat money. Correct? And what is the source? Sale. This sale comes because of what? That finished goods production is more, sales is more, but this machine is disturbing the entire production process. Disturbing. I wanted to continue or replace. I wanted to replace this. I wanted to replace this with a new machine. Replace it with a new machine. Such that production process will go in a high speed. Instead of producing 1000 units in a day, I can produce 4000 units in a day. More supply means more sale can happen for me. Correct or not? Now what is the bottleneck here? X, Y, Z? Answer. Y replaced with Y1. Y replaced with? Now you answer my question. Common sense now. Whenever you are purchasing any machine, you should consider profits, you should consider cash flows. Just now I said 15 minutes back, you forgot. Whenever I am taking a decision, capital budgeting decision, I should consider profits, cash flow. Now I will ask, because of this machine, listen, because of this machine, how much cash flow is generated? Bad response. No, all those are nonsense answers. Because of this Y1 only, tell me how much cash flow will come. See, X is one machine, process 30%, send to Y. Y will process another 40% and send to Z another 30%. 30% lo no one will buy. 40%, 70% completed ki no one will buy. Product should be ready by 100%, then only people will buy. Hey, shirt is there, buttons are not there. Who will buy? No one will buy. Shirt is there, hands are not yet stitched. No one will buy. Correct or not? Everything is ready, stitching is not done. No one will buy. When you will buy? 100% it should be ready. And we are more specific when you are buying a cloth or a textile good. For example, you are buying a dress, you are buying a shirt. Buttons are loose, almost de-threading. It will remove, it will go out. We will buy or will not buy? For a small button, you won't buy. Process is incomplete, means which fool will buy? If you buy, he is a fool. Correct or not? Now tell me. Cotton will be sent into X machine. Made into cloth in the machine to dyeing will be done. Color will be given to that. Stitching and other things will be done by machine 3. Which machine is important now? All machines are important. Cash flow is given by X, Y, Z. No one will give, finished good will give. Are you understanding or not? No one will give. Who will give? See, my company is having only machine X. Machine X lone everything will be done. All revenues are accountable to X. But here I can't tell X because this much came, Y because this much came, I can't tell. Therefore, do you know what they will do beautifully? Without Y1, what are the revenues you take? Full revenue, this revenue. With Y1, what are the revenues you take? A balance is the benefit of Y1. Hello, I'm talking to you. What I said? Cash flows without Y1. Cash flows without Y1. Next, cash flows with Y1. Balance is what? Cash flows because of Y1. That's how incremental cash flows are calculated. Do you understand the point? Then you can tell whether Y1 is to be replaced or not to be replaced. We will accordingly take a decision. That's why always old new data will be given in a question. Understood or not? That's why see. Incremental NPV. Listening? Okay. Tell me now. See. Because of new machine, this new machine, wastage will be reduced. What is reduced? That's why with 1,26,250 material we can sell this amount. Old machine how much material should go inside? 1,80,000 material should go inside. But here 1,26,000 I am doing, and the loss is getting reduced. Listening? Unnecessary wastage, everything with little amount of material only we will give the output properly. Understood? Like that you should experience the chapter capital budgeting and do. It's not like question answer. And why a new machine is more mechanic intensive than labor intensive. That's why number of people working on the machine is reduced. Labor cost also reduced in the machine. Clear? Same. All are reducing. See here. What is this? But we should take profit or cash flow na? Loudly. So we need to add back some depreciation, other things. Are you understanding? EDN. Loudly. As per income tax, as per Companies Act. Companies Act. That's why we should add back this and deduct the income tax rates. That's why I said both are required. 24,000 to 41,500. Those are under income tax, Companies Act. Companies Act. When you add back, what you should add back? What you deducted first should be added back. Correct? And then what you should deduct? Income tax depreciation rates you have to deduct. But income tax like SLM and WDV. WDV means big statement we need to prepare. That's why this concept came. Are you listening, everyone? Closing balance, opening balance is not the thing. Middle red color you didn't you see? Okay? Read the notes. Do you understand explanation clearly? Understood? So those in live, did you all understand? Those all in live, did you all understand? Okay. Understood? See this. I am giving 2 minutes time. No going back. Prepare properly, complete in the class itself. What I have done, understand it properly. See, first PBDT I have taken. PBDT. What is PBDT? Can you please tell me? Profits before depreciation. By adding back the depreciation, I calculated profit. Clear? Now I will reduce depreciation as per income tax, add back again income tax rates, such that perfect calculation will come for the cash flows. Correct? Sir, how you got 80,000? See, tell me, what is the PBT? 3,24,750. Next one 3,87,250. Correct? This is before tax or after tax? Before tax. Before? Okay. 324,750 plus depreciation. Tell me. See, here I have given. See, like this. $80,000. Did you understand now? Ante with Y machine, in our example with Y machine, I will get a adjusted PBT of how much? 348,750. With Y1 machine, it will become how much? 428,750. And how much increment it is giving? Answer, yeah. 80,000 it is giving. Okay. That 80,000 is the benefit. 80,000 is the, but this is subjected to depreciation or not? Depreciation we have to calculate as per income tax. WDV, SLM, WDV. So we calculated WDV. 7.5. 3,50,000 into 7.5. 26,250. Closing balance. Next year ke opening balance. I think you know depreciation, na? I put this here. 2 minutes time I will give, analyze it properly. Tell me whether you understood or not. Those in live also, please take the session seriously. Complete the important and difficult problems in the session itself. You need not do all calculations. 1 year you do calculation and check. If it is right, now every year same concept. I will ask one question, will you tell? Will you tell? I will ask a question. In the columns 1, 2, 3, 4, 5, 6, the sixth column is what? Sixth column. 1, 2, 3, 4, 5, 6, sixth column. What is the profit after tax in the first year? 625, correct? What is the next column after that? How it became 63,875? Depreciation will be added back. What depreciation this is? 26,250. Income tax depreciation. Same depreciation will be added back. Understood? PV factor will be 10%, they have given in the question. Remaining is same. Listening? See how easy it is if you do. You should know, that's it. Once you know, over, done. Concept will be very easy. Now did you understand how to understand the incremental concepts? Whenever two machine data is given, what is the first thing that should come in mind? Don't calculate separately, calculate incremental. I think you understood the meaning of what I discussed now, correct? Next. Let us go into the next discussion. This is how your presentation should be. You should be very clean in presentation. When you write something, valuer should get interest to value your paper. It should not create irritation to him. Presentation is the key for FM paper. It is not about reading something or remembering something. How good you are in presenting your answer. See, normally I am asking, it's not about me that I am writing the notes. Did you find the answer very clear here? See, they didn't tell you. Presentation, when you see step 1, one calculation, step 2, one calculation, step 3, one calculation, step 4, payback period. Like this if you do, why you will commit mistakes? So that's why I always tell students, regular class, listen properly. Because when you understand the FM properly, then CF and AFM becomes easy. Listening? So problem what is happening is, we are not learning at the interlevel in a proper way. Then automatically the impressions will fall on CA final. Because CA final is a continuation of inter. It's not an entirely new subject. Because cost of capital is a chapter in CA inter, correct? Cost of capital 8 marks questions will come in exam. 8 marks ki what you will do here is a working note in CA final. Understood? It's a working note. What you do for 6 marks here will become one working note in CA final. Again, at that time, what faculty will assume? General, I don't assume, I will explain again. Normally, generally, what faculties will assume? You might have already learned at inter-level, but they don't know about us. So, learn properly. Sorry. One by one, techniques I will take now. Okay, one by one techniques I will take and I will explain. First technique, ARR. What is it? ARR. Directly from the notes I will explain first. See here. See, name of the concept is ARR. ARR means what? AR Rahmana. What is ARR? Account. There are two names. Accounting rate of return, average rate of return. Okay, also called as a book rate of return. See, accounting rate of return, when I say, the word accounting should give you an impression. Accounting will not calculate cash flows. Accounts will prepare profit. Therefore, the technique based on profit. Answer over. First point. Understood? What is the name? Accounting. Accounts will consider cash flows. Profit. Therefore, this is dependent on profit. That's why profit will be there in numerator. Understood? Tell me now, what is the formula for return on investment? Ratios chapter. Sir, see, one thing. In entire FM, if any person asks me, what is the most important topic in real life? In real life, everything is useful. Undoubtedly, every concept is used. Widely used. Ratios. If a student could not understand ratios chapter properly, he is gone. Because ratios is the crucial thing in finance. Because health diagnosis of a company will be made through ratios chapter. Understood? What diagnosis? Health diagnosis of a company. Whether a company is financially healthy or about to die, we can understand easily through ratios. If you find time, that's why I am telling, if you find time, in the YouTube channel, in my channel, I kept one video relating to TCS. Which company? TCS financial health analysis I have done in ratios chapter. 8 or 10 ratios I have taken. Capital structure ratio, profitability ratio, turnover ratios. We calculated and said how good TCS is. You can go and see that. Such that at least you will understand whether real life we have to use that ratios or not. Did you get my point? Therefore, first tell me, what is return on investment? Everyone. Tell. What formula? Formula you tell. Wrong. Listen. Return on investment means return divided by investment. That's it. Answer over. Return divided by investment. Return divided by investment. See, formulas we will mug up first. It's a dirtiest thing that we can do in FM. See, common sense, the 100 problems, the 99 can be considered through common sense. Okay? What we do is exactly reverse. 100 la one time we will use common sense, 99 times we will behave like a fool. Common sense, let us understand. Denominator la what is there? Investment means equity, debt. Investment means whose investment? Equity investment, debt investment. Both. So denominator la total investment will come. Both equity investment, both will come. Okay, next. Understand the income statement. Sales minus costs, EBIT. Okay, from there important. EBIT is a amount that belongs to equity and debt. Two people are 1%, 2%, 5%, 100%. To whom it belongs to? Answer. Wrong. 3. Government also will take share. So, EBIT belongs to? Answer here properly. EBIT belongs to 3 people. Denominator, how many people are giving money? 1%, 2%, 3%. Me bonda, 2% are only giving money. Money given by 2, but sharing is done by 3. That's a problem in company. Money is given by 2. Sharing is done by 3. Wrong, na? Answer, yeah? Denominator, equity investment, debt investment, both. Both. Government is also investing money in your business. No, but they are asking share or not. Government is the only villain in entire world where without giving money they will ask a share. Understood? Denominator, who is there? 1% or 2%? Numerator also, you should take such a return which belongs to 2 only. Government should not be there. That's why EBIT into 1 minus T we will take a numerator. That's how the formula came. Understood or not? Tell me, what is the return on investment formula? EBIT into 1 minus T divided by total investment. And equity as well as debt will come into the picture. Understood the point clearly? Yeah? Answer. Is the point here. How it came in, this is how the formula came. Okay? So, why I am asking this now? There is a reason. Without reason, why I will ask? Do you think I am a mad fellow? See, capital budgeting decisions are taken by investing debt money, equity money. Both money will be involved. Correct? Answer. Project is done for whose benefit? Equity benefit or both benefits? Only for equity. The first moral of the story you should understand. See, whether business is a flop or a hit, I have to pay interest on debt. Whether project is a hit or fat, what I have to pay? Interest I have to pay. Then how can you claim that project belongs to me? If you put the hand, they will cut it into pieces. Whether project is a utter flop or it is a super duper hit, we have to pay you interest. That means you are least bothered about project. Who is bothered about project? Therefore, whenever in capital budgeting return means profit after tax, not EB18 into 1 minus T. Equity part only you should consider. That's why profit will come in the numerator here. Did you understand or not? What only will be considered? The answer, yeah, what only will be considered? Loudly? Very good. Denominator, what is there? Originally, average you leave. What is there? Investment. Investment. Numerator, you are taking EB18 to 1 minus T, profit after tax. So, denominator, what should come? Denominator, investment. Whose investment? Both investment or only equity? Both will come because money taken from both, but profits are enjoyed only by one. That's called as financial leverage. I will give you an example. Understand. She is equity. She is debt. Bank, equity shareholder. Okay? I will take 100 rupees from her. I will take 100 also from her. Equity is there, debt is also there. What is also there? Both of your money I will take, invest in a project. Listening? She is expecting 16% return. She is expecting 10% return, bank. Listening? I will invest her money at some rate, her money at some rate, like that, like a fool we will not invest. Money may be taken from different sources, but investment will be made at one rate. Correct? I took 100 from you, 100 also from you. How much is there? 200. Where I invested? Project. Project gave me 20% return, but I will give you only 10. Correct? Therefore, investment will be taken. See, here what is happening? From your 200, from your 100, I got 20 rupees, but I will give you only 10. Correct or not? A remaining 10, who is eating? That 10 rupee extra came because of equity or debt. Equity, the equity I will give you. That extra 10 rupees came because of whom? Debt. That 10 rupees came because of whom? How much I took from bank? 100. Invested it? 20. Received how much? 20. Paid only how much? Answer. 110. Capital 100 I will give. 10 rupee interest I will give. And how much I have? How much I have? Yeah, extra 10 rupees I am having. With the bank's money I am talking about. Equity money, forget, yeah. Equity expecting how much? 16. From their money, 4 rupee gain. Forget about equity, I am not discussing about equity. I am talking about debt. Debt money, how much I have taken? 100. Put in a project giving me? And extra how much I got? 10 rupees extra. That 10 rupee I am getting a benefit because of whom? Debt. That's why since benefit, profit after tax law, whose benefit is also there? Debt's benefit is also there. You should take debt also in the investment here in this formula. That's how all these concepts came. Understood the point clearly? Yeah? The idea behind this ARR concept. They say in Instagram stories, if you see it, you see it. Means if you can't see, you can't see. But if you see once, you can't unsee again. So from now when you are reading the concepts, it makes a lot of difference. When you see something, a difference will be there in thought process. Sir, anyway, understood the logic clearly, yeah? Okay, tell me, what is in the denominator? Investment. See, profit by investment means what? Return on investment formula. Ante, this concept is nothing but return of investment in a different way. In a different way. Instead of taking overall company profit, we are taking the project profit. Numerator? Because you took money from debentures also, debt. Okay? You invested somewhere. 20% return came. Where the 20% will go? Into the sales. Into EBIT. But you will not pay entire 20 rupees to her. Interest deduction like 10 rupees you will take. A balance who is eating? That's it. That's why profit after tax will be considered in the numerator. So project is always done for whose benefit? That's why equity you will not pay EBIT. Equity you will pay PAT. Understood or not? Live batch answer. Live students, everyone understood clearly? Listen, story not yet done yet. Main concept will start now. Understood the formula, na? But problem will come this way. See, now equity debt is not the point of discussion. See here. What happens is, numerator what you will take? Numerator what you will take? PAT. Every year profits are calculated, but every year you don't invest. Hey, how many times you will invest? One time you will invest. With that, how many years profit will come? 3 years. So 4 years. The life of the project. Every year you will put investment. No, you will put investment only once. So tell me, investment is made every year. Sir, where you will invest? In our chapter, in capital budgeting chapter, where you will invest? In a machinery or something, some assets you will invest, correct? You will invest every year. Answer? Yes. No. Reinvest. Assets you will reinvest. No. Listen. This concept is different. This conceptual knowledge itself is variety, this concept here. Though ARR is the worst way of analyzing a project because of profit involvement, concept is very interesting. I will give you an example. See the screen. See the screen. I purchased a machinery. I purchased what? Machinery. Machinery, 1 lakh rupee, 50,000 equity given, 50,000 debt has given. Okay, wow. How much equity given? 50,000. Don't unnecessarily bloat the amounts. How much equity has given? 50,000. Debt has given? Both has given 1 lakh. What I will do with 1 lakh? Put in dustbin. I will invest. Correct? So, life. Okay? Asset value. Asset value. See. How logically they brought the concept of ARR, that we should appreciate. 0, 1, 2, 3, 4, 5. 5 years life. Life is moving on right side because life can't go back. Okay? As the life is moving, because of depreciation, asset value will reduce or increase? Answer, yeah. See, 0. It starts from 1 lakh, wait, 1 lakh, 80,000, 60,000, 40,000, 20,000, 0, correct? Sorry, okay. Very. Choose. Ah, everything is gone. Hmm. Day 9. During revision classes, say all this nonsense will happen. Normally, when I am writing at room, nothing will come. When neck of the moment I need to teach something new means problems will start. Ade life. Which document we need to open? Capital budgeting. Yes. Sorry, okay. Now, life 0, 1, 2, 3, 4, 5. 5 years life. Correct? Hey, look here. Value. 1,80,000. SLM. Simplicity sake. SLM. 40,000. 20,000. 0. Don't take accuracy now. Just understanding. 0 year. And you purchased. At what price? 1 lakh. 1 year after, asset is depreciated. 1 year after? See, like this you should understand. 0 to 1 is 1 year. 1 to 2 is 1 year. 2 to 3 is 1 year. 3 to 4 is 1 year. 4 to 5 is 1 year. Like that you should understand. Answer. 0 to 1 year, you are using a machine which is worth 1 lakh. Correct? 1 year after, asset value is not 1 lakh. Yeah. Asset value is only how much? 80,000. Ante, what is the meaning here? For 1 year to 2 year, you are not using a machine which is worth 1 lakh. You are using the machine worth only. That's why denominator la average investment concept came. Now do you understand the point or not? So that's why they came with a concept called as average investment. Do you know how this look like? See, like this it will look like. Understood? And as the time is passing by, what will happen? Value of the asset also will fall. See, 4 years after, how can you tell that you are using a 1 lakh worth machine? Common sense also, if you think properly, you are not using 1 lakh worth machine after 4 years. After 4 years, you crushed it to almost everything. Until 5th year, you are not using a machine worth 1 lakh, you are using machine only worth 20,000. Therefore, how can you take 1 lakh commonly for all the 5 years? How it performed 5 years before, how come you can expect the machine to perform in the same way after 5 years? It will depreciate. Correct? That's the concept of ARR. Understood? I will give notes for you. Don't write anything. Just one thing. One concept I need to clear first. Once it is cleared, we will go to next concept. See here. What is the denominator? What is average investment? Answer. See, formula. Read. Original investment minus salvage value divided by 2 plus salvage value plus work. So this formula require analysis for almost 1 hour. That's why you can see. This is all analysis I have given in the notes. See, formula 1, formula 2, meaning, analysis. See how much it was given. But now I can't do all those things in the limited time available. Remember this formula. Tell me, what is the formula for denominator average investment? Original investment minus salvage value divided by 2 plus salvage value plus working capital. Remember, don't ask me logic now. This is not a time. Because you should first understand why divided by 2. All these we need to do. Understood the point clearly? Yeah. So I can't do all those things now. Time waste. Not time waste. I will never tell it's a time waste. Sufficient time is not there for me to explain all these now. Okay. So, but if you want me to ask a question, I will tell. Tell me, what is the formula for average investment? Not this formula. Generally you tell the answer. What is the meaning of average investment? I will ask one question, answer. Investment is a positive thing or negative thing? As a number, Investment is always a negative number or positive number. Cash flow is a positive number, undoubtedly. Investment is a outflow na inflow na? Very answer yeah. Outflow. Okay, what is it? Outflow. Okay, now tell me what is the formula for average investment generally? Opening investment plus closing investment divided by 2. Opening investment plus same point. See here and tell. Okay, see here and tell. 1 year after, what is the value? Huh? At the point, tell me, opening investment 1 lakh. Opening investment plus closing investment is how much? Answer 0. Wrong. I am getting a salvage value. I am getting a salvage value is a investment inflow na. Investment is positive here. So inflow should be, that's why minus salvage value divided by 2. Closing value is salvage value there, which is a inflow. Now read. People don't become Kaushik just like that, Nana. How many hours of hard work is there inside my performance, I will only know. People will just like that think. It's very easy to teach FM, very easy to teach DT, very easy to teach law. It's because it takes lot of years of efforts. Read properly. The live students answer. Negative. Negative means he is telling about salvage value. You understood now why negative salvage? Yes, okay, ba. So, sir, then why they added salvage, sir? Question will come. Sorry, original investment minus salvage divided by 2, understood. Opening, closing is a negative here. Inflow, rather than outflow, we add an inflow. Correct? So, divided by 2, logical understanding. Correct? Now I will ask a question, tell me. What is the opening investment? Original. Original means opening. How much? Answer. Closing? Closing? Hey, you are taking how much here in the formula? Minus 20. Minus? And technically it is giving a impression as if your original investment is only 80,000. Correct? But you really invest only 80,000. Invested 1 lakh. And how much is missing here? 20 is added back again. Understood the point? And one side we have done average, one side we have done the factual numbers, everything was taken. That's why these are all concepts became worldwide popular. Sorry, understood the concept clearly? Done. This is all about, what concept we did now? Average rate of return, also called as what? Accounting rate of return. Shall I show you super duper bumper blasting problem on ARR? Kaska. I don't know exactly number. When I see question, I will understand. Yes, this question. Super duper bumper blasting question on ARR. See, expected cash flows of 3 projects are given below. Cost of capital 10%. Calculate payback NPV IRR. Accounting rate of return. We are in accounting rate of return. Let us see only that part. Okay. Now, this data given. Analyze the data first. One sec. Let us see if there is anyone in the live asking any question. Live students, are you all clear up to here? Go on. All of you see the question properly. Take 2 minutes time, read properly. I have a good question, that's why. Okay? Have you seen or not? Now I'll ask you a question, tell me. In that question, we have to do average original. Don't throw stones. Confidence. Tell what to do. Average. So to do average, what data is required? First tell me that. To do average investment, what data is required? You should be given opening investment. The original investment. You should be given a salvage value. Working capital, no problem. If they give, you can take. Salvage value, all these things should be given or not. And you should be given with what information? Original investment information should be given. Correct? Salvage value should be given. Thereafter you have to take. Correct? First answer my question clearly. This particular data, whatever they have given, okay? These all, first of all, that means can we use this data in first basics we can calculate? Answer, you cannot. These are all cash flows. ARR uses profit. First bomb blasting point in this question is, ARR uses cash flow na profits? Loudly. Profits it will use, not the cash flow. Cash flow it will not use, it will use the profits. So what we have to understand, ARR uses profits, not the cash flows. From this, the first moral of the story, it uses cash flows, profits, not the cash flow. So cash flows should be converted into profits. How to convert them? See, question number 16. Just a minute. What is illustration number 16? Just wait a minute, I think I haven't done that. Similar question is there, that's why I might have left that. Similar 15. Same 15 we will see. Same question, yeah. That's why I might have done only one out of both. 15, 16 both are same. So I have done one. See, even 15th illustration. Let us take project D. Project D. How much is investment? 10,000. First year, how much I got? 10,000. Next year, 3,000. Next year, 3,000. What are all these? But ARR calculation ki what we need to consider? Profits are cash flows are. These are all what? Convert them into, like this you need to convert. See, two alternatives of answers are there. Are you listening? Two alternatives. First alternative, directly, average investment you will take. Sir, the average profit after tax. Average profit after tax. How much it is? Loudly. Here they have given cash flows. Considering cash flows as profits. Considering cash flows as profits. Same you will take original investment, you will get one answer. But this is a right way, wrong way? Wrong way. And generally we can do, but not correct. ICA will follow another way. That's why I have given both the answers as per ICA. Now please apply your mind. For which project? Project A. Average profit. Given amounts are? What is a cash flow? Profit after tax plus depreciation. I want profit after tax. So what we do? Cash flow minus depreciation. Cash flow minus. Okay. Now, profit after tax is how much? 10,000. How much? 10,000. So profit after tax is cash flow minus depreciation. You see here. ARR calculation. Year after year, let us see. First, project A. Project A. Tell me, project A, how much is the outflow? What is the inflow? Loudly. What is the outflow? How many years life? And everything will be depreciated in 1 year. Tell me, what is the formula for cash flow? Profit after tax plus depreciation. What is profit after tax? Cash flow minus depreciation. What is the cash flow? 10,000. Minus depreciation is how much? So value will be how much? 0. That's what we have done in the first case. Project A. Low. So we calculated 0. Average investment the same. Opening investment plus closing investment minus salvage value divided by 2. Are you with me? Opening investment how much? 10,000. Salvage also not given. So closing the salvage value will be same. Plus 0 divided by 2 plus salvage value plus 0, 5,000. Okay, wow. So IRR calculation, how much it is? 0. See the study material now. First is 0. How much I have done analysis? See the institute answer, direct one step. What student will understand that 10,000 minus 10,000 into half divided by 10,000 into half? What they will understand if they do like that? That's why presentation matters. Sorry. Which project we are taking now? Project B. No. Let us take difficult one. Let us take project D. Project D. Tell me. Project D, what is our investment? Loudly. What is the profit? 10,000. Cash flow 10,000, 3,000, 3,000. Correct? Okay. Now tell me. 10,000 rupees is the investment. Okay. 10,000 rupees is the investment. See the screen now. See how I have done, you see. First, profit after tax. Profit after tax. See. Total cash flow. How much? 10,000 plus 3,000 plus 3,000. Totally how much? 16,000. So, numerator is 16,000. Understood? Answer, yeah. Minus, what is the investment? 10,000. What is investment? 10,000. Sorry, depreciation. I'm very sorry. What is the depreciation? 10,000. 3 years ki I'm getting 16,000. Depreciation is how much? 10,000. Average investment mean divided by 3. How much it came? 2,000. Are you listening, everyone? Tell me, what is the formula for cash flow? Profit plus depreciation. Correct? I want what? Profit. Cash flow minus depreciation. Cash flow minus? Okay. We can't do for year of year here. So therefore we will take all the 3 years cash flow. How much is the 3 years cash flow? 16,000. Minus depreciation divided by how much? 3 years. Why 3 years? Life is 3 years. Understood? Means average every year how much profit is coming? 2,000. How much? Denominator of what should come? Not number. Denominator of what should come? Average investment. What investment? Okay. Tell me, what do you mean by average investment in all the cases? Yeah? Average investment means what? Tell me. Opening investment plus closing investment minus salvage value divided by 2. Anyway, salvage not given. What is the opening investment? 10,000 plus 0 minus 0 divided by 2. How much it will be? Answer is 40%. Everybody understood ARR? So after going home, what you have to do? First ARR questions you have to do. Okay? Did you understand ARR properly? Yeah? Practice is required. 1-2 times if you do questions, you will get confidence how ARR will actually look like. Hopefully everyone understood this with clarity. Everyone? So those in live, you people also should give an answer. Did you all understand the concept clearly? Okay, done. So tell me now, did you all understand ARR concept clearly? Yeah? Okay. See, mainly difficult areas I will be covering. In that ARR we completed. Payback period, small area, I don't want it to take much time. I will just explain the concept. Payback period means time taken for getting back our principal. Time taken for getting back our principal. Bigger the payback period, bad the project is. Lower the payback period, good the project is. Okay? What I said. Higher the payback period, bad the project is. Lower the payback period, good the project is. From payback period point of view. I am not telling always this is right. From payback period concept point of view, you see higher is worst, lower is best. Lower means what? We are recovering the principal in just lower time. One project is taking 3.5 years and another project is taking 2.3 years. Means your principal is getting recovered in 2.3 years only. But there is a disadvantage with payback period. Payback period, you will see only the time to recover. Time to? See, I will give you an example. Not like this, I will prepare an example. See here. Problem is that only study material don't do any analysis, directly some questions and answers nonsense. See here. Shall we? Project A, project B. Project A, 1, 2, 3, 4 years life. B also 4 years life. Okay. A, investment is 10,000 or 50,000. B investment is also 50,000. A, first year 25,000, second year 24,000, third year 30,000, fourth year 10,000. Okay, wow. B, first year 10,000, second year 20,000, third year 10,000, fourth year 90,000. Okay? Tell me. From payback period point of view, who is good? They use mind. Yeah, 1% mind if you use, answer will be completed. Tell me, how much you invested? In that almost 49,000 is recovered by the end of second year itself or not? Hardly another 10 days or 1 month required to recover the remaining. And this project is taking hardly 2.1 years to recover back the principal, correct? But If you observe the second one, it is taking around 3 point some number of years. And from payback period point of view, if you see who is good, but try to understand total the overall cash flows. Okay, 25, 24, 49, 49, 30, 79, 79, 10, 89. But next project, 10, 20, 30, 30, 40, 1 lakh. Just because of analyzing project using payback, you are losing a great opportunity. Correct? This is like in search of gold, you lost a diamond. Are you understanding the point or not? So that's the problem with payback period. Payback period always analyzes only the recovery speed. It forgets to discuss about how much benefit in cash flows it is going to give. Clear? Tell me, payback period is useful in what? I will understand your understanding on capital budgeting. Tell me, payback period is useful for what? Everyone, live, Zoom. No, not break even point. See, listen carefully. Payback period is always concentrating on speed in recovery, not in the overall benefit to the organization. It will concentrate on speed in recovery. Concentrates on speed in recovery. Better the payback period, better will be the IRR. Better the payback period, better the IRR. Projects which are favoring through payback will have more IRR than projects which are unfavored by payback. Do you know what is IRR concept? Speed in recovery of returns or investment. Speed in recovery. See, one project is there. Overall cash flows are very less. But the way in which it brings out the capital back, 2 years when everything will come back. That means rate of return is more. Overall cash flows are less. Correct? But NPV don't behave like that. NPV sees the longevity of the project. More cash flows. You may be very slow. Consistently you bring the cash flow. Are you listening? Normal, regular class when you have to think about NPV IRR, I will take one example. That example I will teach for 2 classes and 6 hours it will take. One problem. But that one problem if you do properly, life again you will not forget NPV IRR. Because NPV IRR, the psychology of NPV IRR you will understand through that question. Okay, I will show the question here. Just try to analyze it. Okay, that question will be useful for you to understand what is the importance of NPV and importance of IRR in decision making. Are you understanding the point clearly? Yeah. So, see, NPV concentrates on overall cash flows. IRR concentrates on speed in recovery of principal. Projects favoring PBP, and I mean payback period, will have higher IRR. Projects which are non-favored by payback will have a lower IRR. Though they are very good projects. Though they are very good projects. Those are not favored. Are you understanding the point clearly? Yeah? Please tell me, what is the formula for IRR? IRR, there is a annuity cash flow without discounting. If you have to tell how to understand IRR, IRR means it is simply, listening, IRR represent cash flow divided by investment. Cash flow divided by discounting cash flow divided by investment you will do. Are you listening? IRR is internal rate of return. And a rate of return means return on investment. Return divided by investment again. Understood? Okay. What is the formula for payback period? What do you mean? What is the formula for payback period? It's in years. It's in investment divided by cash flow per annum. Investment divided by 1 lakh investment, cash flow per annum 40,000. My 1 lakh will be recovered in how many years? 5 years. It will be 2.5 years. It will be recovered. Correct? Tell me, what is the formula here? Investment divided by cash flow. What is IRR formula? Cash flow divided by investment. Inverse of PBP IRR. That's why IRR analysis ki PBP will be used. Do you understand the concept or not? That's why error calculation we will use payback period very often. Understood? That's the reason, yeah. Live students, did you understand? Yeah. So, yes. So since the time has crossed the level, you need to leave. What we will do is, in next session when you take, we will start at 4 o'clock itself, such that we can take up to 7:30. Listening, next class. Now I am also having a recording at 8 o'clock. So we will do one thing. Next session, our live students also, Zoom live students, will stop here. Next session, we will be starting at 4 o'clock itself. I will plan accordingly and I will let you know, such that we can start at 4 o'clock and end by 7 o'clock or 7:30, such that we can complete full-fledged this particular area, and we will go to the next important called as ratios. Are you clear, all the live students? 2 days. Next session we will complete capital. Next one we will go for 3 hours complete discussion on ratios chapter. Are you listening? Next one is a debtors management we will do. Which one? Debtors, working capital management, debtors management. My main topics are 3. Number 1, capital budgeting. Number 2, ratios. Number 3, debtors. If you can club all the 3, magics will happen. You will definitely get that 40 marks in exam out of 50. Clear? Okay then. Thank you very much. Good night. So very good evening. So in the previous session we already started with capital budgeting. A quick revision we are doing on concepts relating to capital budgeting. Yesterday we came across certain important things which we don't have clarity before. Those are the concepts relating to ARR, payback period, discounted payback. I have shown you in the last class very clearly, correct? Today's session we are going to complete NPV, IRR, EAB, EAC. Main techniques we will complete. Yeah? Hardly 1 hour, 1 hour 50 minutes we will complete everything. Let us understand what is the meaning. Later problems you can also do. Listening? I will show you for each concept one very good problem, like what we have seen in the yesterday's class. With that you will get the clarity. Shall we continue? So listen now. In the last class we have done the concepts relating to payback period and ARR concepts, and we try to understand the concepts relating to ARR and payback period. Payback period, I told you the meaning. What does it mean? Payback period represents time taken for recovery of our investment. How many years or months time it will be taking to recover the principal is called as payback period. Lower the payback period, better the project will be. But always going as per payback period is not a right idea, because payback period ignores projects with huge inflows, but which will come at a later stages. Longer duration projects with bigger cash flows are often ignored by payback period concept. Understood? That's what we have seen. Let us see how questions are being tested on payback. This is the question. Okay? Read the question for a minute. We will do payback period on calculator directly. Read the question. First tell me, have you read? Take calculator now. See the question. project A, if you observe, which one? Project A. If you observe project A, how much is the cash flow? Every year, how much is the inflow? 900 into how many years? 10. How many years? Our capital is how much? How many years it will take to recover that principal? Simple logic. Listen. 5,000 is the investment. Correct? Hello? Each year how much I will get? To recover that 5,000, how many 900s have to come? This per annum. Every year 900 will come. And how many years I need to wait with 900, 900, 900, 900 to reach 5,000? 5.5? 5 like that it came. So 5.56 years. And every year, if I get 5.5, 900, 900, 900, 900 like that, by the end of 5.56 years, my capital will be recovered. Understood? Next. What is the second project? Project B. Now see, all cash flows are same, cash flows are different. Now cumulative we have to calculate. What we have to calculate? See here. 700, 1500, 2400, 3400, 4500, 5700. Did you understand what I have done? First year how much is recovered? Start again. How much I invested? First year how much I received back? Still how much is there? 4,300. In that how much is recovered in the second year? 800. Total recovery by the end of second year will be 1,500. Correct? Okay. Still 3,500 is there. Correct? In that how much is recovered in the third year? 900. How much? 900. Now again balance is there. Like that, between 5 and 6 years, my principal has been recovered. Correct? Tell me. By the end of 5th year, how much is there? 4,500. By the end of 6th year, how much is there? 5,700. And 1 year, how much increase happened? Answer, sir. 1,200. Ante full 5 years it is taking, and it is not taking full 6th year. It is taking only part of 6th year. 1 year if you can recover 1,200, 500 will be recovered in, means we recovered 4,500 by the end of 5th year. Still how much is there to recover? 500. 1 year I have taken to cover 1,200, means 500 will be recovered in how much time? 0.67. Correct? So we can call it 5.42 years. 5.42 years. Understood or not? Tell me, how many years we recovered? 5.42. Next. See there. How much we invested in project C? 5,000. First year how much is recovered? 2,000. Next year how much is recovered? Third year how much is recovered? 4,000. Totally 6,000. Correct? So tell me, 2 years ki fully recovered. Correct? 2 years ki 4,000 is recovered. Okay? Still how much is pending? 1,000. 1 year less 2,000 recovered means half year is recovering 1,000. Correct? So answer will be how many years? 2.5 Tell me, what are the three answers? 5.56, 5.42, 2.5. Over. Understood the point clearly? Those all in the live, please answer. Understood? Everyone in live? Okay. Now, next, what we completed now? What completed? See, exam la question came. Like this they gave. They asked you to calculate payback. Always remember, exam la payback is asked. It means we have to calculate normal payback, not discounted payback. Understood? We have to calculate normal payback. Now I ask you one answer. Did you do any discounting for this? Directly you calculated, correct? Huh? Nothing is said in the question. Just they asked calculate payback. What should be calculated? Normal payback. If it is discounted payback, they will ask clearly. Now doubt will come. Sir, what is this discounted payback? Nothing great. For these cash flows, if you apply discounting factor, what factor? Hey, PV factor, na, you will get PVCF or not? These answers are called as discounted cash flow. For that you will calculate cumulative. Same logic, everything is same. Discounted payback, discounted factor will apply. Non-discounted payback, directly you will do. Understood or not? That's it. Which concept we completed now? Payback period, discounted payback period. Two things are completed. ARR completed, payback completed, discounted payback completed. Next area is NPV. Now, see here. I asked them to close the door once. Thank you. Okay. Now tell me, what is the next concept we are going to start? NPV, net present value. Okay. Now, listen, what is this NPV? NPV, if you ask me, 2 hours we can discuss. But in the little time that is available, I will explain first what is the ideology behind NPV. NPV represents value over investment. Value over investment. I kept 100 rupees. How much I received in excess of 100 is called as what? NPV. NPV is excess over investment. Excess over? When I say excess over investment, that excess should be discounted value. Excess should be? After discounting, that should be calculated. Understood? But the logic is much more clear. See the screen once. Okay, let us take an example first. See, 1 second before we start, I just want confirmation from all the live students. Are you all listening, everyone in the class? Live. Yeah. So please listen. Problems anyone can do, first understand the concept. That gives 1,000 tons of confidence than doing 1,000 problems. Understand concept, you can do problems on your own also later. Listening. First understand the logics. See, it is a 3-year project. It is a 3-year project. 15 minutes I will take. NPV I will explain. 15 minutes I will take. IRR I will explain. 15 minutes I will take. EAB, EAC I will explain. Grand one problem, let us solve. That's it, over. Remaining is entirely your practice. Listening, remaining is completely a practice. You practice 5-6 problems more. That's it. You will get confidence automatically. Concept if you understand, automatically questions also you will understand. When you don't know what is the concept behind this, every problem is a new problem for you. Listening? Same, what we are doing for the tax, same. If you understand one thing, remaining becomes easy. If you don't understand concept, every problem is a difficult concept for you. So concentrate on concept, not on problems. You do problems, I will not deny. First understand the concept, later you can do problems on your own. See, how many years is the life of the project?
3 years.
How many cash flows? 3 cash flows. Discounting factor, PVCF, some amount came. 127, 340. 127? 340. What is 127, 340? What is 127, 340? All the live students also, don't ask any doubts now. Let me first complete 15 minutes. Put your heart and soul understanding here. Your life will change in NPV understanding. Now tell. What is 127,340? Present value of future cash flows. Present value of? A fool. Who? Fool will only think like that. So never understand that way. See, a fool only will understand that this is a present value of future cash flow. No. This is called as fair value. Enna value? Loudly everyone. What is fair value? Let me explain. There are three values always. Fair value, market value. Again, tell me first one. Fair value, market value, nominal value. Tell me. Fair value, market value, nominal value. Shares na three values will be there. Fair value will be there, market value will be there, nominal value also will be there. Assets, plant and machinery, nominal will not be there, fair and market will be there. I am talking to you. Tell me, what are the three values? Fair value, market value, nominal. We are not going to discuss about this. Anyway, we are talking about capital budgeting, na? Not about shares. Correct? So only two values will be there. Tell me. Fair value, market value. Now, listen carefully. What we say is, what generally experts say is, see, you wanted to go from one place to another place. Okay? You take an auto. You stopped a person. You asked, I wanted to go from Veshmambalam to T Nagar, Chennai. I have to go from Veshmambalam to T Nagar. Say example, it's a 4 kilometers journey. We have an estimate. City is having extreme traffic at some times in the day. Therefore, maybe each kilometer, ideally they may ask 30 rupees. Understood? 30 rupees ideally they may ask for each kilometer. 4 kilometers, 30 into 4, 120. Plus or minus 10 rupees you are tolerable. Clear? Now tell me, how much you are ready to pay? Loudly. 120 or 10 rupees extra. 130. You stopped an auto. Okay? Now tell me, how much is the worth of 4 kilometers journey in Chennai city? Maximum how much you are ready to spend? 130 is the worth, that's all. Beyond that 1 rupee also I am not interested to pay. Listening? Actually I will be there always. Yearly half the time I will be there only. They charge only 90 to 100. I am telling 130. Clear? Sorry, 130 rupees. Let us understand. My mind has already fixed that I am ready to pay only how much? Beyond this 1 rupee also I don't pay. I will go for alternative. Okay? Because no one will get money free of cost. 1 rupee is also important for everyone. Understood? Now listen carefully. 130. I stopped. I asked, how much is the price from here to here? 3 situations came. That auto wala said 130. Okay? How much he said? Adi market value. What is the fair value in my mind? 130. You will accept or not accept? Maybe accepted, you may bargain also a little bit. Correct or not? So, but okay, not a no. Next. How much he said? Sorry. How much he said? In your mind, how much you are ready to pay? Now tell me. The fair value of this journey is 130, but the person is ready to give only at how much? 100. You will accept or will not accept? Happily accept. First go inside. Understood? Here plus 30 value came for you. Correct? Next, third one. He said 150. You are ready to pay only how much? You are having a deficit over your expectation, surplus, deficit. I am ready to pay only 130. That fellow is charging. If I go, I will be ended up with a minus 20. Here, these are all NPVs. NPV concept is nothing but fair value, market value minus fair value. Market value minus, or actually they say fair value minus market value. Fair value minus, loudly, fair value minus is called as what? Loudly? So now answer. What is this? What is this? Difference will be called as a market value, na? Understandable. Go to the market, inquire the price, a price a market value. Understood? Go to the market. I wanted to purchase a phone. Phone has a market price. I go to Aptronics or some Apple store. Okay. I ask them, Anna, how much is this? They said 1,70,000. The market value. I went to the market. I said, how much is this mic set? They said 10,000. Market value. Listening? Fair value, market value, both are not same. Fair value is the greatest invention of the mankind. What is fair value? Fair value of any asset is present value of future cash flows discounted at required rate of return. Required rate of? Okay. Now listen carefully. Present value of future cash flows discounted at a required rate of return is called as what? Loudly. Which value? Not market value. It's called as a? I will ask a question. I will ask a question. See here. Idanna? Answer. Required rate of return. Required rate of? See. This is also called as a PV factor. Let us say 10%. How much percent? 10%. How this 10% came? Listen. I have borrowed from a bank. I took money also from equity shareholders. I borrowed money from bank. I also took money from equity share. Combination I raised funding. Okay. Now answer my question. If you raise the funding in a combination of equity and debt, equity expect KE. Equity expect debt expect KD. Debt expect KD. Understanding sake, KE is 10%, KD also 10%. Understanding actually KE will be much higher than KD. I also know that. Example sake, let's put the example very simple. Okay, so tell me, how much equity is expecting? 10%. How much debt is expecting? 10%. Answer. 10%. Both are expecting total of 20%. See, 50% I raised by KE, 50% I raised by KD, 0.5 into 10, 5, 0.5 into 5, 10, sorry, 0.5 into 10, 5. That's how 5 plus 5 became how much? 10. That's how this 10 came. Naina Chitti, show some expression on face. Understood up to here? Tell me, how much is the PV there? 10. How the 10 came? 50% of 10%, another 50% of 10%. Both put together became how much? 10%. Understood? 0.5 into 10, 5. 0.5 into 10, 5. 5 plus 5, how much? 10. Are you listening? Now I will ask a question. See, I went to LIC. LIC HFL. Loans are given by LIC, na? LIC insurance company won't give. LIC HFL division will give. Listening? They saw my CIBIL score, my company CIBIL score. They saw prompt payments, super CIBIL score, 850 plus score. When CIBIL score is more, interest rates are less. Are you listening? Because of that reason, they charged me only 10% interest. Listening? My company is prompt in paying dividends. Every year, with a little amount of growth, consistently I am paying dividend. Therefore, shareholders are also safe in my company. Risk is very less. When risk is less, return also is less. Therefore, they are expecting 10% from me. Understood? Now, justified for my example. So, 10% KE, 10% KD. Let us understand this way. Clear? This is my situation. He also have a company. worst in making payments, default, willful defaulter, RBI list la his name is there, don't give loan to him, example. Okay, in willful defaulters list la first name. Now answer my question. Civil score 200. Okay, Vijay Mallya will have better civil score than him. Such a situation he is facing, miserable situation. Now tell me, bank will give him loan at 10%, they will charge high interest rate. Loudly, bank said 30%, want to take, take or else go out. How much interest for him? 30%, 50%, 50% means 15% he has to pay. Hello. Next, equity shareholders also lost belief on him. Listening? They are expecting 20%. 20% into 0.5 again. How much? 10. How much percent? 25. My PV? Your PV? Now you answer my question. Person to person, PV factor will be same or different? Company to company, PV factor is same or different? PV factor depends on the risk of that entity. Risk of the? So now answer my question. Why I am telling all these things you will understand in a while. Tell me, what is the fair value of any asset? Present value of future cash flows discounted at required rate is called as what? Fair value, not value. Fair value. Fair value considers three things. Number one, present value, future. Present to future means time is considered. Present, future means I am talking about a time dilation. Understood? Next, what is this? Cash flows. Time, cash flow. Third one, discounting factor. What factor? Then that will be called as what value? Use your common sense if any. Tell me now. Idenna? 1 minute. Idenna? Loudly. These all three cash flows are already happened cash flows are expected to happen. Already happened, expected. Already happened, why it will become budget? We are doing capital budgeting. Budget la we take expectation, future or past? Tell me, these three are guaranteed expectation. Definite, doubtful. Answer. Fantastic. Tell me, these are all future or present? These, you only said na just now, these are all present values or future values? These are all present values or future values? Answer. These are all future, these are all present. Understood? This future was brought to present using a time machine called as PV factor. Using a time machine called as a? Okay. Now tell me, what is the fair value of any asset? See there, not my face. See there. Hey, one second. See, I will tell, you need not. See there. Fair value of any asset is present value of future cash flows discounted at required rate. That's why I call this fair value. Understood the point? A fool will be there, na? That fellow only will read this present value of future cash flows. Those who don't have proper clarity on financial management concepts, na, they call this present value of future cash flows. From today, never say that. Understood the point? Those who don't have good clarity on financial management, they will mug up the concepts and automatically. They will remember this as PVCF. Fool he is. So take care when you are understanding the concepts. Don't become a fool. Listening? Understanding sake they kept that table like that. But in reality that is not the meaning. Are you listening? Yes, tell me. Idenna? Very good. These are all present values or future values? Of what cash flow? Discounted what rate? Required rate. My required rate to your required rate is same or different? Different. Very good. Now tell me. These three cash flows are actual or expected? Expected by me. If you expect, another answer also can be expected. You may expect 80,000, 55, 15. Or you may expect 45,000, 60,000 and 92,000. These are whose expectation? These are whose expectation? Valuer's expectation. Whose expectation? I am valuing. These are my expectation. She will value. Different expectation. She will value. Different expectation. Ante for different persons, this will be same or changing? Loudly. That's called as a fair value. Market values don't change. You go to market, ask how much it is. 1,70,000. She will go and ask how much? 1,70,000. She will go and ask how much? 1,70,000. 1,70,000 is standard. Market values are standardized. Fair values changes with the valuer. Are you understanding the point or not? One stage of discussion completed. Let us see what is the response of the students in live. All the students in live? Clarity? Don't call it as PVCF. Everyone in live, tell me who will call it PVCF? They will give a response now. Oh, nice. Adi. If anyone calls that as PVCF, na, first call him, "Arey fool, go and learn FM properly and come back." Nice. Nice, nice. Adi. A fool will be there, na, that person only will read that as present value of future cash flows. From today, you also, if anyone says that PVCF, na, arey fool, first go and learn properly and come back again. Okay? So, listen carefully. Idanna? Adi correct, undoubtedly. But this is not PVCF. This is called as what? Fair value of an asset. Independently, you can call this PVCF. Cumulatively, you should not call them. Arey, understanding, ah? So, independently, these are PVCF, undoubtedly. But cumulatively, you should not call it present value of future cash flows. It's cumulated. It became fair value. It became what value? Idanna? Present value of first year cash flow. Idanna? Present value of second year cash flow. Idanna? Present value of third year cash flow. Idanna? Present value of all years cash flow, you should not tell. What is this called? Then cumulatively it came fair value. Understood the point? Huh? Answer. Yes, see, building is constructed. What is this? Brick, cement. Okay. After construction is completed, what is this? Brick, cement. Who will tell? Who will tell like that? Yeah. That's what I also said. Online report. Day online la any fool? Why no one is answering? Silence is taken as acceptance. Super extraordinary clarity. Kaushik Mukesh, if he tells super extraordinary quality, clarity, Kaushik Mukesh, I'm not asking about clarity is there or not. If I tell clarity, why it will not come? I am asking, did you understand what I said now? Yes, sir. Yes, sir. Yes, sir. Yes, sir. Yes, sir. Yes, sir. Adi Kaushik da. Sorry. Next, let us continue. Sorry. Now, let us go on into the next area. Next area means not IRR. NPV la one segment completed. Second segment let us enter and understand. Now you tell me. You now transferred from fool to a normal person, a wise person. Tell me what is this? What is this? Present value of future cash flow. Cumulatively we call it fair value. Up to here understood? Okay, next. What are all these? Future cash flows. Independently future cash flow. These are all independently present value. Cumulatively we don't call it present value. We call it as what? Fair value. Understood? This will be compared with what? This is a fair value. Compare with what? Until do you know what does it mean? I am ready to pay this much for this asset, but available only at how much? 1 lakh. I am getting a benefit of 27,340. Ade NPV. Are you understanding the point or not? So I am ready to spend how much? 1 lakh. I get a benefit of 127,340, but available only at how much price? 1 lakh. I am getting an extra benefit of how much? 27,340. NPV positive, accept the project. That's how people started analyzing the projects. Understood the point clearly? Not yet completed. Stage 2 completed now. Everyone understood NPV calculation? Tell me, NPV question came in exam. Forget about the concept now. From exam point of view, what we need to do? Year, cash flow, PV, PVCF, total them. You will get the answer. Are the fair value minus market value, cost of the asset. Balance will become what? NPV. Positive accept, negative not accept. Answer over. Understood the point clearly? Yeah? But listen carefully. What is this? One second. What is this? Market value. In another way, how to tell this? In another way, market value, undoubtedly. Market value, what you have done? You purchased. What you have done? Purchased. At what price? Answer. 1 lakh. When you will purchase? You will purchase after 3 years, huh? You will purchase today, na? Answer. These all will come today, na? After 3 years, huh? After 1 year, after 2 years, after 3 years. This is today. These are all. To compare with this, you can't compare directly, na? That's why we will bring it into present value and compare. Understood the point now? Why we will do present value? That's why it's called as a net present value. Because this is happening in present stage. So, when you compare something, na, compare in a fair way. If this is present, if this is a future, how can you compare one future and one present? Understood? See, see the screen. I have $55,000, euro 80,000, rupee 15,000. How much I have? You will tell I have 55, 80, 15 dollar pound, dollar, euro, rupee. Or you will total all the three. 135 plus 15. I have 150 dollar, euro, rupee. No. Correct or wrong? Wrong. What you have to do? Convert everything into rupee and then total. Correct? Same. When 3 different currencies you can't total, 3 different time frames like cash flows, how can you total? You cannot total. Therefore, bring it into common time frame. A common is present. Common is? That's it. So therefore, already one thing is in the present happening. To compare with this, those also should be brought to present. Present 127,340. Stage 3 discussion also completed. Everyone understood? Now the final point. Analysis. Up to now, what we have done is analysis only, na sir. Listen. Main concept will come now. Listen carefully. I will take this. See here. Okay? Okay. No answer. Calculators, everyone have a get ready. I will ask, then you use it and tell. Okay. Now listen. Why gap is given? You will understand. Something will be coming in that gaps, which creates more meaningful understanding of that NPV table. Okay. See here now. 55,000. One minute before we start. Online students, are you all listening? Okay, done. Okay, see here. First point number 1. Listen, question number 1. What is the discounted cash inflow? Fair value. How much? 1,27,000. How much is the disco? Disco is 127,340. Disco means what? Dancer. Discounted cash outflow. How much? 1 lakh. Correct? Is it inflow or outflow? It inflow na outflow na? Technically inflow minus outflow is NPV. That can be negative, that can be positive sometimes. Okay, now tell me, what is this 1 lakh? What is this 1 lakh? Disco, okay. So normally, what is that 1 lakh? What is it? Market value. What you did at market value? Purchase. Perfect. Huh? What you have done? Purchase. And the inflow na outflow na? You purchased. Okay. Purchased out of what? Stolen money. Yeah? What you have done? Loudly. Not borrowed. Both. Equity is there. Equity is not a borrowing. Na? 50,000 is borrowed fund. 50,000 is equity funding. Or resource and surplus. Anything. Something. Equity 50%. Debt 50%. Both has given how much? 1 lakh. So tell me, how much equity given? 50. How much debt given? 50. Both how much given? 1 lakh. All that 1 lakh you brought into the business and you purchased the machinery. That machinery is expected to give a present value of how much? 127,340. I will ask a question, tell me. 1 lakh is principal, interest, only principal. That 1 lakh is principal amount invested. That 1 lakh is having interest amount also. Na? This 1 lakh is principal, principal with interest. Principal only. How much you have given? 50. How much you have given? All interest also included. On that I have to pay you interest. Low. So how much is there? 1 lakh. How much? Sorry. Normally what we learn, NPV positive, accept. NPV positive, NPV negative, reject. Now my question. NPV depends on DISCO. DISCO is a capital principal and interest. Principal. Correct? Therefore, DISCO is also what? Principal we will receive to pay the principal already taken. Low. Principal we will receive to pay the principal taken. We will, listening, see, let us say 1 lakh 1 we received. Normally what you will do? Theoretically you tell first, practically forget about the concept. DISCO minus DISCO, positive, what we have to do? Accept, negative, reject. Hey, correct or not? Here how much is a NPV? 1 rupee. Normally what you will do? NPV means blindly what we will tell first? Accept the project, take up. Then who will pay interest? Grandfather will come and pay, na? Do you understand the point or not? The online students, answer, did you understand the query? Done. So everyone understood the question or not? Hey, DISCO is what? Principal. Obviously with principal, interest and principal can't be compared. Na? Principal recovered versus principal taken is a concept of NPV. What is what and what? How can you tell that it is a principal recovered, this one? Because we are doing capital budgeting. We will see only capital, not return. We are comparing capitals with capital. Capital recovered, capital raised. Understood the point? Capital recovered versus capital raised. How much is your recovery is a question here. I recovered 1 lakh 1 rupee principal, but I need to pay only how much principal? 1 lakh principal I should pay. So how much extra principal recovered? Blindly what we will do? Accept the project. But this project is capable of recovering only what? Principal, not the interest and dividends that we need to pay. Understanding the point or not? So now tell me, is it the right way of analyzing the project? Answer, yes. That's what makes NPV the Maharaja of capital budgeting. Listen carefully. Problem is about understanding. See here. 1 rupee also you should accept. That's the power of NPV concept. Let us understand what is NPV. See the screen now. See there. What is the, how many years cash flow? Cash flow given a? PV factor given a? Answer. See, listen, always listen, life, never forget this rule. CA final, there is a concept called as a base case NPV, adjusted NPV. What concept? Adjusted NPV. Capital vesting is there also in CA final, it will not leave you. Capital vesting, here we are seeing capital vesting. There you will see advanced capital vesting as well. Not normal. Serious students will cry seeing those questions. Questions, all questions, every question 3 pages, 4 pages. So they will ask huge questions in CFI and AFM. There we will enjoy like anything after seeing the concepts. But to enjoy there, first you should enjoy here. Or else there cut, gone over CFI and AFM. See, recently you saw, na? My student has got the highest mark in AFM. India, that is highest mark for the last attempt. Last attempt, that fellow got highest mark, 95 marks he got in AFM. Like that, what? One person, 7 students got more than 90. See, that their greatness they will do, but try to understand that interest should come now first to do AFM. CL 90 plus imagination, it will be in a very level. That interest should be created on that FM paper. That starts only at inter level. Inter level, if a person hate FM, na, final never he will love that subject. He will only mark for that 50 marks in exam. Please don't do that. Sorry, let us understand. See the screen once. 3 cash flows are given. PV factors given. Listen, there is a rule. Whenever you apply PV factor on any cash flow, whenever you apply PV factor on any cash flow, with what name you applied, that will come out of it. With what name you will apply, that will come out of it and become invisible. And become invisible. I will explain this way. See, how much is a PV? Very good. What is the 10? So what is the 10%? That is a return expected by fund givers. Return expected by fund givers. Yarra fund givers? Debt, equity. Weighted average 10% is the expected cost of both of them. Hey, 10%, 10%, 50%, 50%, total became 10%. Okay, 10% is what? What is that 10%? 10% is the return. 10% is the... Now listen carefully. Take 55,000. Take? Apply PV factor on that. What is a PV factor? See there and tell what is the PV factor? 10%. What is the 10% answer? Hey, I am asking PV factor answer. 0. 0. So listen. Take 55,000. Take. Apply PV factor. How much? 0.909. Correct? What is that 0.909? Ray 49 odd nonsense. Start again. 55,000. What is 55,000? Cash flow. 10% is what? Interest return expected. What expected? How much return expected? 10%. At 10% how much is the value? 0.909. Wrong. 10% value is not 0.909. 10% answer will be 1 minus 0.909. Which is invisible. ఏంటి 55,000 లో 49,000 రిటర్న్ ఈ అడుక్కుదే నాలుగు రోడ్డు మీదకి వెళ్ళి. This is principal part. Do you understand what I said? Start. How much is this? 1 rupee 0.909 is a principal. 1 rupee 90.9% interest if they pay, direct kuberane. Are you understanding? Amma, Thai, direct road companies, if they pay like that, this is not interest payment. This is what? That's why, tell me, take a cash flow. Take a apply what factor? With what name you apply PV factor, that will be separated and become invisible. You can't see in the table. Now we will show that in the table. Invisible thing, let us make it more visible. Tell me, what is the interest recovery? Return recovery. 0.909 means 1 minus 0.909. Tell. 0.091 na? Okay. 1 minus 0.826. 174. 1 minus 0.751. 24? Okay. Now, how much is this? Now multiply with this part. 0.091. 55,000 into 0.091. That's the return component. 5,000? 5. 80,000 into 0.174. 13? Very good. 15,000 into 0.249. 3735 total. 5005 13920 3735. 22,660. First of all live students reply. Up to here everyone understood clearly. Okay. Now, so up to here understood everyone? Hello, I'm talking to you. Yes, tell me. Take a. Apply. With what name you will apply PV factor? That will be separated from the table, becomes invisible. They don't show that. Because we want principal table, not interest table or return table. That's why in this table we can't see that. But actually it's there. Understood? It's like a 1 plus 0 equal to 0. 0 there. But it is invisibly there. Understood? Okay. Now answer. Tell me, 55,000 is present or future? Future. 80? 15? Now tell me, which is more futuristic? 15. Which is moderately futuristic? Which is less futuristic? But all are futuristic. Future is certain or uncertain? Sorry, I will tell. I gave you 100 rupees to pay me after 1 minute. Or I gave you 100 rupees to pay now itself again in 1 second. Future is there or not there? Not there. Risk or no risk? Because you are there, I am there, my 100 rupees is there, cash you will put here immediately. When risk will come? As the time passes by, future comes into picture. What will start coming? Risk will start. Now tell me, 55,000 is more riskier, 80,000 is more riskier. 80,000 more riskier, 15,000 is more riskier. More risk means you will ask less return or more return. That's why see return portion will increase. First you ask 0.091, next you ask 0.174, next you ask every 1 rupee 24.9. As and when risk is increasing, what you will recover more? Returns you will recover. Are you understanding or not? Means how to understand NPV table? See, how much you receive? What is the outflow? What is the net? Do you know what is the meaning? Your project is so strong project that it paid returns to the equity, it paid returns to the debt, it paid 50,000 capital to equity, it paid 50,000 capital to debt. Even after that another 27,340 is there. The most strongest projects these are. That's the meaning of NPV. Do you understand the concept clearly? Yeah. And what is also recovered here? After return recovery. But in the table we can't see that. That's the problem. Understood the point clearly? Yeah. That's what the concept of NPV reality people wanted to convey. Understood the point clearly? So, in this is the meaning of this table. If you see this table normally, yeah, so these are all will be there, will not be there. We don't even understand. Correct? That's why I call people who do FM without a clarity a biggest fool on the planet, because he is useful for nothing, fit for nothing candidate. Because in real life you can't do anything. Are you understanding? So that's the point here. Hopefully you understood everything what I said till now on NPV. Correct? So tell me, NPV considers capital repayment or principal repayment returns also. Final answer la principal recovery is there, but actually what is also paid? Returns also are paid. What also are paid? Returns also paid. Means what do you mean by 27,340? What do you mean by 27,340? In this 55,000, in this 49,995 is a principal, and 5,005 rupees is there. 5,005 la some part goes to interest payment, some part goes to dividend payment. After that still I recovered how much principal? 49. And these are all principal recovery, principal plus interest recovery, principal recovery after paying what? All returns. All the means 1 lakh is what? Principal. When I compare something with principal then I will compare. Return should not come into picture. Therefore, after removing the returns, this concept will come. That's why NPV is the Maharaja of the capital budgeting. The way in which NPV concept people brought, where a level they brought this, that's why even till today, worldwide, project analysis means the only model is net present value, undoubtedly net present value. NPV versus IRR, NPV is the best technique to follow. Understood the point clearly? Yeah. So this is the point. Yeah. Hopefully everyone understood. Our students in live, now you can answer. Understood or not? Okay. Next. I think now you can do any number of problems on NPV. See, this is done. Another question, if see, this all I have written in the notes, just for your understanding sake. Okay, this is all the analysis for NPV calculations. Sorry. Over. NPV concept, everyone understood clearly? Yeah? What is the formula for NPV finally? DISCI minus DISCO. What is DISCI? Last column. Present values total. DISCO, outflow. This is the full way of understanding NPV concept. A fool will understand this way. Present value of future cash flows. Okay? Please don't understand that way. That have a meaning. That consolidated number is not a present value of future cash flow. What is it called as? Fair value. What is that? Fair value of an asset. Compare it with the market value of asset. Positive accept, negative don't accept. As simple as that. Okay? Next. What is the next one? Profitability index. Simple concept of profitability. NPVA in a different form. Rather than telling a DISCI minus DISCO, they will tell us DISCI divided by DISCO. DISCI divided by? Obvious na? Project if it is negative. Project if it is? NPV, sorry, PI will be there na? Which one? PI will be in less than 1. PI will be less than 1. Positive NPV, more than 1. Exact NPV, 0 value will be there. 0 positive accept. Negative more less than 1 reject the project. Understood? See, tell me, answer my question. Is there any great use with profitability index? I am asking, NPV you will calculate. Without NPV calculation, how you get the PI values? And a PI is not anything which is greatly found. It is nothing but another way of expressing NPV concept. Understood? And if I understand NPV, is that enough or not? No. Other concept, or else why PI will come into picture? Sometimes NPV fails in analyzing the project, not in calculations. PI will do that. Whenever NPV fails to analyze a project, who will come into picture? PI will come into picture. Okay? I will give you an example. See here. Where NPV fails, PI will play a crucial role. Project 1, project 2, project 3. Okay? Project 1, project 2, project 3. Outflow, and discounted outflow. 100, 200, 50. 3 different projects. Understood? 3 different projects. Okay. Now, tell me, discounted inflow. Discounted already. You need not discount anything. Already calculated and given. Are you listening? Discounted cash flow 200. How much? 300. Or I will write this way, 350. How much? 350. Next, 120. How much? 120. Now, see the screen once. NPV of project 1, 100. Project 2, 150. Project 3, which is having highest NPV? Hey, see there and tell ya, which is having highest NPV? So 3 projects, which one you should select? I asked you mutually exclusive. Only one you have to select. Which one you will select? Answer, yeah. Which one you will select? Second we will select because it is having higher NPV. But wrong. That is not the way. You imagine this way. Listening? Huh? Yes, see there. PI if you calculate, DISCI minus DISCO 2 times. Okay, va? PI if you calculate 350 by 200. 1 point? Next. 120 by 50. 2 point? This is the best project. Do you know how to understand this? See, I will explain. Shall I? Yes, see here. Generally people tell you can do project 2 because it is having higher NPV. Correct? Yes, answer. Yes, project 2 ki how much capital is required? See the screen. Project 2 ki how much capital is required? Project 3 ki? Ante I can continue, I can do 4 projects of project 3 by the time I complete project 2. Yes, how many projects of project 3? 4 projects. And I will get 4 120s. I will get 4 70s. And I will get 280 instead of 150. Yes, do you understand? Huh? And if you see only NPV, project will be favoring which one? 2. Listening? Yes, but if you calculate PI, you will get for 1 rupee how much NPV is generated. Understood the point? That's how the PI concept came into picture. Did you understand? Remaining everything is same. So where to use PI? Where to use PI? Capital rationing. Whenever limited capital is available. What capital? Limited capital, but I need to put in 1 or 2 projects. At that time PI will come. That's why you can see in study material, any capital rationing question, step number 1 is PI. Understood the point clearly? Yeah? You have to first calculate the PI and then do the remaining things. Understood the PI concept? Huh? Study material, one question is also there on PI. See, 3 projects. DISCI by DISCO, 6 lakh 50, 5 lakh 50, 1.18. Hello? 95, 75. 1 point. Next project is very big, crores light is there, but 1 point. So which is better, project 1 or 2 or 3? 2 is better, because by the time you complete project 3, project 2 I can do 100 times. Are you understanding or not? I can do 100 times. I will get 100 times 1.27 for every 1 rupee. I am more performing project than you. Are you understanding the point or not? This is the concept of PI. Everyone understood? Next. What is the next concept here? IRR. Let me ask the students in live. Understood PI concept, everyone? Next. What is the next one? IRR. IRR means what? Internal rate of return. Internal rate of return. Okay. See, how to understand IRR? IRR is a rate. IRR is not an amount. IRR is a rate at which inflows will actually equal to outflows. When I say inflows, discounted inflows. Discounted inflows exactly matches outflow, or discounted inflows minus discounted outflows is 0. Is 0. Answer, one question we have done just now. 10% of 1,27,340. Answer, 1,27,340 when you got 10%. It is not 10, that is 14%. That is? Ante they are asking high return or low return? Answer. And higher amounts of return will be taken. And the principal ki lesser amounts will come. Correct? Therefore, automatically 1,27,000 will come up more than 1,27,000 or less than 1,27,000. And at some rate, it will become 1 lakh also. That rate is called as IRR rate. That's why they don't tell what is the rate. Trial and error, we need to put the numbers and do the calculation. Understood what I said? In exam, what they will give? They will give or will not give? Will not give the rate. Randomly, we need to assume some number. That's why rough paper first we need to take. Understood? Roughly, sir, Adi Kaushik Mukesha, everyone have to do in the same way. Take a rough paper, fastly put the numbers. 2 minutes you need to spend on that. Put one number there, some percent, some 12 or 13 or something you put. Listening? If it is coming near to the outflow, one rate above, one rate below, you should take and do. Hello, your answer is in 1,40,000, question is in 25,000-30,000, you have to adjust a lot. Next rate should not be near to that. 10-15% extra you need to take. Do you understand what I said? That's how we need to do. Shall we see one question? See. I will show you a question. NPV. See here, this question only. Normal regular class la NPV IRR comparison will come. Exam they are not asking that, but still class la, regular class la, how can we tell? Let's go by exam pattern. We have to tell everything na. NPV IRR conflict will be there, you know? No, because most of the people don't even learn this concept called as NPV IRR conflict, because that requires lot of CA final AFM knowledge. Okay, so that's why people don't. Sir, there in the syllabus or not there in the syllabus? Listen, 7 questions are there in your study material on this. All study material questions say from where I will bring. Understood? Exam they are not asking. I am not telling not there in your syllabus. Pakka it is there in your syllabus. Are you listening? But exam they are not asking because of length of the answer. Okay, but let us understand idea. NPV calculation, let us see. NPV IRR. NPV, let's see. See the screen once. There are 2 projects. Sir, I will go a little faster. Please listen carefully. Okay. How many projects are there? Both the projects require a outflow of how much? 1,10,000, 1,10,000. We wanted to know which project is better. Which project is? There are 2 techniques. NPV, IRR. NPV, IRR. Are you listening? NPV and IRR. Okay. Now, we have to calculate NPV and IRR concept now. Okay. How to do NPV for project X? Tell me the schedule. Year, cash flow, PV at the rate of 10%. Given in the question you can see. Cost of capital is how much percent? 10%. Below blue color. Okay. Reinvestment you forget. I am not going to discuss about that. So 10%. PV at the rate of 10%. Final column? PVCF. Final column? Tell me, what are the cash flows? 31,000, 40,000, 50,000, 70,000. 4 cash flows. PV at the rate of 10%, 0.909, 0.826, 0.751, 0.683. 4 rates will come. Correct? Multiply. PVCF will come. Compare it with 1,10,000. Like this answer will be. First of all, understood NPV concept clearly, yeah? Nothing great. Already we understood the meaning also for that now. But IRR is the main thing, yeah? IRR is danger in exam. Listen. They don't give you IRR rate. We should do. Clear? We should do that. Okay? Tell me. Question is given like this. What you will do in exam? First, assume some rate in mind. Start with 15%. Start with 15%. You will get one answer. That answer should be near to the outflow. Near to the outflow how much here? Your answer is 5,45,000. It is not even nearer. Understood? Or your answer is 11,500. It is not even in the reach. When 1,10,000 means 1,20,000 or 1,97,000, in that area your answer should come. Hey, answer. So I will directly show the answer to you. I have taken 24 to 20%. How much? 20%, 24%. 20% how much is the answer? 116,273. Very near to 1,10,000. 24 how much I got? 106. Here two things we learn. Number one, rate should be near to your outflow. Next, more PV, lesser capital recovery, because more PV means more return is recovered. So lesser principals are recovered. Hello? That's why these numbers are like that. Understood? So, see, next one is very, very important. Hey, you know, IRRK formula will be used. Delta, lower number by higher number. You did not do that way. This is the easiest method. PV, how much percent? What is the future value? Fair value. I'm very sorry. What is the fair value? 1,16,200. Hey, here numbers are there. At 20%, what is the value? 116,273. At 24%, what is the value? 106,796. Correct? We want 116,273. 106,796. 1 lakh. 1,10,000. So, see 20% horizontal line. Horizontal line, not vertically. Horizontally you should see. Tell me, at 20%, what is the fair value? How much you want? And what is the value difference? Very good. Second, 24% also you see. At 24, what is the fair value? 106,796. You want how much? There is a deficit of 3,204. Correct? Now you can do from any of the point of view. Either do from 20% or do from 24. I will do both. Class I should tell the student both sides. See, 4% change ki value changed by 9,477. Below. For 4% rate change, value changed by how much? 9,477. Correct? From 20% point of view, if you see, for 6,273 value, how much percentage? Understood? Okay. Hey, 6,273 is a plus or minus? Plus or minus? So this also will be plus. 2.64 or 65. 22.65 is the answer. Understood? Go from 24% now. 4% how much change? 9,477. From 24%, what is the value change required? Minus 3,204. Minus. So how much minus? 1.35. 24 minus 1.35. Again 22.65. They listening everyone. What do you mean by 22.65? IRR. What do you mean by IRR? Don't tell full form, internal rate of return. What do you mean by 22.65? You should understand. Hey, at that point NPV is 0. At that point discounted inflow match with outflow. What is the 22.65? Long answer. What is 22.65? Shall I tell you? Shall I tell you? See, that is the maximum cost of capital at which you can raise your capital. Beyond that, if you raise your NPV will become less than 0. Always IRR 22.65 means the PV factor 22.65. PV factor is what? Return. Means, see how great IRR concept na? If you calculate IRR na, first you will know what is the rate at which I can raise the capital. Tell me, my maximum tolerance rate at which I can raise the capital is how much percent now? 22.65. I went to a person, I asked, I want 1,10,000. I want 1,10,000. I asked, what is my maximum rate? 22.65 is the maximum. At that rate only 0 will be coming. Anything higher than that if I pay it will become minus. So with what mind we will go to banker now? 22.65. I will ask the fund giver, how much you are charging? He said, I want 25% return. We will tell, namaste. One person said, I want 20%. I accept that. That's how IRR is used. Fundraising IRR, project evaluation NPV. Both when used together, miracles will happen in companies. Understood the point clearly? So now everyone, students in live, answer, did you understand? Okay, done. Last concept. After that, one session let us take to do some problems. Okay, don't spend a lot of time on learning at this time because exams are very near for you, na? So therefore, those who are writing for September exam, daily 1.5 to 2 hours systematically if you do from now, it will be completed. Next class what we will do is we will do problems on capital budgeting. 6 problems we will do. Understood? How many? 6. Not 6 small problem. Let us take good problems. 6 problems let us analyze. That's all. All models will be covered in that. Clear? Before going into that, last concept. EAB, EAC. EAB, nothing, a small concept. See the notes. My notes you don't see because that has lot of analysis. See, now we have done one question, 22.65. What is the meaning of the 22.65? See, this is all the meaning. Meaning of terms. Prove that NPV assumes cost of capital at reinvestment rate. Conclusion 2. How reinvestment rate affects the project selection. Reason for conflict. How to resolve the conflict. Can the reinvestment rate be more than COC? What is IRR rate? Then what can be reinvestment rate? Stage 6 analysis again. Finally, this is the final answer. But that we can't do at this time now. That's why I am not doing all those. Next one is the disparity, life disparity. This is again a big analysis. Other EAB, EAC. But I will directly come to the point without explaining any concept here. See here. Yesterday I told the financing cost irrelevance. Hey, interest. I said very big notes is there. Here are notes. See there. Financing cost irrelevance. That's called as a total fund approach versus equity shareholders approach. Then practical problems will begin. Sorry. Let us now go to EAB, EAC question. Shall we do? See here. There are 2 machines. Machine X, machine Y. Machine X running cost per annum is 4 lakh. This is EAC question. Equated annuity cost. Because cost question was given. Hey, answer. Inflows if it is given, it will become equated annuity benefit, EAB. Concept is ditto, yeah. Sometimes benefit will be given, sometimes cost will be given. These are cost. See the screen. What is the running cost per annum? Answer. Why? 6 lakh. Which project is more costly? Which project is more costly? That we will see. Okay, we will see 4 or 6, we will tell project Y is very costly. Correct? But wrong. Project X is a 3-year project. Project Y is a 2-year project. Then how can you compare? Both are not of equal lives. Na? Answer everyone. So therefore, when you are comparing 2 projects, projects are not of equal life. Projects are not of equal life. Therefore, when equal lives are not there, you can't compare both the projects. Common sense, na? Project having higher life will have higher inflow. There is a project, 6 years life. There is another project, 3 years life. Which project will have more cash flow? 6 years project. Correct or not? A player played for 100 matches. A player played for 400 matches. Both are good players. Which player will get more runs? Player playing 400 matches only will get. How can you compare like that? It's a wrong comparison. Then what to do? How to compare? 2 options are there. What if this 100 matches player played 400 is one way, or divided by total 1 match average you calculate for both of them. Are you understanding or not? What match average? Hey, total runs 25,000 divided by 400. Per match average will come 100 matches. These many runs divided by 100. Average will come the correct comparison. Understood or not? You should not compare a 12,000 cricketer with 18,000 runs cricketer and tell 18,000 person is great. See number of matches, how many this fellow played. Understood the point? Same comparison. When two projects are of different life, you cannot compare them directly. Either take everything into future or bring everything into one match point of view. Same here we are doing one match. Listening? Formula I will tell you, listen. NPV, repeat. Divided by PVAF. Answer over ante ade EAB EAC. Let's do problem tomorrow, then you will understand much better. Concept is 1 minute, but if you do one problem, you will get full clarity. Understood or not? Next class we will do the questions and answers. All in live, please tell me, did you all understand the concept clearly? Okay, va? Okay, thank you very much. Full day I am having class, I am tired. Next session we will look after the remaining questions and answers in capital budgeting we will do. Along with that we will do working capital estimates. Okay? All the students in live? Yeah. Thank you very much. We'll meet again in the next class. So very good morning. In this session, we are going to continue with final discussion on capital budgeting, and thereafter we will start with the area called as debtors management. Because of a consistent request from the students, let me consider the chapter debtors management, and I will try to cover debtors management as much as possible in detail. Okay, debtors management mattum I am not going to just discuss about the concept and the explanation or one or two. Let us do a decent amount of problems, spend some time on that chapter such that it will be useful to everyone. Are you clear? Yeah. So with regard to the capital budgeting, we already discussed about the following concepts. See there, ARR, payback, discounted payback period, NPV, IRR, EAB, EAC. I will discuss about these three a little bit in detail because in the last class, I know I just explained you the concept. I did not do any problem, or I did not explain varieties of questions that can come. Just I explain what is the meaning. So let us go to some extent of detail regarding IRR, EAB and EAC. After that, there is an area called as capital rationing. What is it? Capital rationing. That also let us do. Then the capital budgeting will be fully completed. Okay. So let us begin. Listen. Study material. Study material. See here. See. Okay. Okay. Now, see here. Illustration 6. This is on IRR calculation. Sir, already we have done a sir. You said some trial and error method we need to use. Listen, I will tell you one example. See. Okay. See here. There are two types of questions that can be given on IRR. How many questions here? Two kind of questions that can be given in IRR. Question type number 1. Annuity cash flow. Which cash flow? Annuity cash flow. And every year same cash flow will come for multiple years. That type if a question comes, simple. DISCI equal to DISCO is the IRR. Means the rate at which NPV when you calculate DISCI minus DISCO na, we will be now doing rate calculation in such a way that Disky and Disco both should be matching each other, or Disky and Disco should be leading to zero answer. A place where NPV is 0 is called as a IRR. Is called as what, sir? IRR. Okay. Disky equal to Disco. What is Disky? Discounted cash inflows means cash flows into PV factor equal to Disco. If it is a 1 year cash flow, PVF. If it is a multiple year cash flow into present value of annuity factor equal to Disco. Okay. So cash flow, this is cash flow per annum. See, A Limited is evaluating a project. Outlay of 10 lakh. Outlay of 10 lakh. Okay. Now, resulting in annual cash inflow and cash inflow per annum of 2 lakh 50. Cash flow 2 lakh 50 for 6 years. Okay. That means 1 year I will get 2 lakh 50 all the 6 years. See, three questions. Only 1 year out of 6 years 2 lakh 50, or 1 to 6 years 2 lakh 50,000 every year, or 6 years total is 2 lakh 50. 1 year out of 6 years 2 lakh 50. No, sir. 1 year to 6 years. All the 6 years we will get 2 lakh 50. No. Not like that, sir. 1 to 6 years aggregate is 2 lakh 50. Which is the right answer? Everyone live. Okay. So each year 2 lakh 50,000. So cash flow per annum. Okay, done. So 1 year ki PVF I wanted to do for 6 years. So PVAF. Okay, you know annuity factor now? Take calculator. See how much to put here. We don't know. Now do one thing. What we need to do is, when question is coming like this, randomly let us calculate. Random 10%, 12%, 14%, like that, let us calculate randomly. Okay, 10% 6 years PV factor, PVAF, 1 divided by 1.10 equal to M plus 4 6 times. 4.355. 4.355. 4.355. Okay, 4.355. Now PVAF we don't know, that is X. X equal to 4. Why X equal to 4? 10 lakh divided by 2 lakh 50,000. So the PVAF answer is 4. PVAF we want is how much, sir? 4. So 10% ki 4.335 we got. Okay. Always remember PVAF value and discounting factor value, both are inversely proportional. Higher the rate, lower the value. Okay. So 10% I got 4.335. I want 4. I want how much? 4. So we need to increase this 10 or decrease or increase such that the value will decrease. So I am taking 12. 1 divided by 1.12. 4.111. Now also I am not satisfied. Why? 12% is 4.111. Okay. That means this is more than 4. I want one number less than 4. 14%. 3.889. 3.889. So I want 4%. I want 4% or x equal to 4. At 14% it is 3.889. We want 4. So 14% is a wrong answer. At 12%, it is 4.111. I want 4. So 12 is also wrong answer. But one thing is clear. It will be between 12 and 14. So, see. PV, actual value, desirable value, delta represents a change. Positive, negative change. PV factor at the rate of 12, at the rate of 14. 2% change. 2 per 12%, what is the value? 4.111. 14%, 3.889. Point triple two. Desired value, we want 4 in both the cases. First case, there is a positive 0.11. Second case, minus 0.111. Okay. For 2% change, PV value is changing 0.222. We want a change of 0.111. So how much we need to change? Minus 1. So almost, see, that answer, that particular answer, whatever we are going to take is 13% around. How much? 13%. See, 12.978 and 12.99 almost equal to how much? 13%. So the final answer is 13% is the IRR rate. That means at 13%, discounted cash inflows matches with outflow. If you want, you can check. 2,50,000 into 13%, 6 years. 1 divided by 1.13. 1, 2, 3, 4, 5, 6. 3.998 equal to, so 2,50,000, so multiply if you do 2,50,000 into 3.998, it is nearing to 10 lakh, which is the discounted outflow. So the final answer is 13% is the actual IRR rate. Everyone, please answer me. Did you really understand how to do IRR in case of an annuity cash flow or not? One reply required. Everyone understood? So, whenever annuity factors are missing in the question, it is as simple as to understand the following. Point number 1. Whenever you have to calculate IRR, IRR represents discounted inflows should match with discounted outflows. Discounted inflow means you can do it in 2 ways. Number 1, discounting on yearly basis or annuity basis. Anything you can do. Either you can do on annuity or you can do on every year basis. Both sides you can do. Okay, listen. If same cash flow comes every year over the life of the project, instead of putting 2,50,000, 2,50,000, 2,50,000, 2,56 times, we can put 2,50,000 one time and total all the PV factors. A totaling of PV factors we call annuity factor. Okay, so he is asking that question here. So what happened in this question? Discounted cash inflows, we don't know, but 2,50,000 per annum, we don't know PV factor, equal to discounted cash outflow is the IRR. So X is the IRR rate. But X is the IRR rate for how many years annuity? 6 years annuity. So we got answer as 4. Now 4% is not the answer. 4 should be the annuity value. How much percentage with 6 years become annuity value? 4. That's what we are going to calculate, and we calculated. At 12% it became 4.1111 or 4.111. At 14% it became 3.899. So for 2% difference, annuity value is changing by 0.222. Okay, for 2% change, annuity value is changing by 0.222. Clear? But we want a change of triple one point triple one in order to reach this 4. So for 2%, if this is a change, this change require how much percentage? We calculated, it came to plus 1. So 12 plus 1. If you go through this route now, that 14 minus that particular thing will give you this answer. Everyone now tell me, understood? No, one person asked doubt in the group, Sharon. That's why I'm repeating. I repeated one more time. He has to answer. Sharon, did you understand? Yeah. So you can find the answer also here. How to present the answer? See, I'm putting the presentation before you. Example, you have to present like this. Everyone understood the presentation? Everyone understood the presentation? Yeah. Next one. See, now we have done for annuity cash flow. Which cash flow? Annuity. Sir, annuity not given. Annuity not given. They have given random data, which is also called as a multiple uneven data. Multiple uneven data they have given. How to do? Randomly, we have to take a trial and error basis. See, I will do for 10% first. Okay. You also do along with me. Don't sit idle. 10%. 0.909, 0.826, 0.751, 0.683, 0.621. Calculate 30,000 into 30,000 into 0.909, 40,000 into 0.826, 60,000 into 0.751, 30,000 into 0.683. It came to 1,38,280. 1,38,280. Okay. So, but Our return of investment, see, this is the discounted cash inflow, fair value. Market value is equal to how much? 1,36,000. Both should be equal. Both should be equal. I wanted to reduce the value now. I got 1,38,000. I want only 1,36,000. Inflow matching with outflow, not matching, not matching. It is in excess. So to reduce, what I have to do? Increase the discounting rate. I will take 12%. I will increase 2%. 1 divided by 1.12. 0.893, 0.797, 0.712, 0.636, 0.567. Multiply 30,000 into 0.893, 40,000 into 0.797, 60,000 into 0.712, 30,000 into 0.636, 20,000 into 0.567. It came to 131,810. Happies. Now what is happening here? Let us see. PV at the rate of 10%, at the rate of 12%. So the value what we obtained is, at 10% we obtained 1,38,280. At 12% we obtained 1,31,810. But the actual value, the desired value, what we need is 1,36,000. 1,36,000. So difference 1,38,280 minus 1,36,000 plus 2280. The important symbol 131,810 minus 1,36,000 minus 4190. Okay, see, now for 2% change, 138,280 minus 131,810, 6470. 6470. For 2%, asset value is changing by, asset value means what? Fair value. Fair value 138,280 when 10% is taken. When 12% is taken, it is going to 131,810. Means how much value is changing? 6470 value is changing because of 2% change. Okay. From 10% point of view, how much value change we need? 2280. Positive plus. So 2280 into 2 divided by 6470. 0.705. No, sir, I will come from 12% point of view. How much? 12%. For 2%, it is 6470 for minus 4,190. How much? 4,190 into 2 divided by 6. Minus 1.295. What minus 1.295? 12 minus 1.295. 10.705. 10.705 or 10.71. Okay, 10.705. We got 10.705. They got 10.704. So if you do in the way I said, accuracy will be like that. Accuracy will be like that. You will get an exact answer what is given in the key of the institute. If you do as per what I said. Okay. So everyone, did you understand multiple uneven cash flow IRR calculation or not? Okay. Next. Then I will give you an illustration question. You will solve. Take illustration 8. I will give you 2 minutes time. Those who see the answer will fail. Don't see. Do mistake. I will appreciate you. But don't copy and write the answers. I will not appreciate you. Simple questions. Read the question properly. I am giving you 3 minutes time. Solve it. Time up. Tell the answer. Time up. Tell the answer. Okay. Now, only few people have given the answer. Last 30 seconds time I am giving extra. If anyone is willing to answer, you can answer. Or else like any other answer, I will only tell. Okay. Time up. See, what is the new point we are going to learn in this question? Okay. I think the first question. What is the new thing we are going to learn? See, sir, here also per annum given. Okay, all are given normally only. What is the new problem is in this question they did not give cash flows. They gave net operating income called as EBIT. We don't want EBIT, we want cash flow. So EBIT 68,000 minus interest anyway not there. Okay, tax is there. How much tax? 45%. $37,400 earnings after tax plus depreciation we need to add back. How much depreciation might be reduced by after on calculating the 68,000? The 68,000 is after depreciation. After depreciation is 60,000, 68,000. So that is after calculating. So again, don't reduce depreciation. We only need to add back. How much to add back? Capital contribution 3,60,000, salvage value nil divided by what is the life? 72,000. 1,09,400. So every year 1,09,400 cash flow will come. For how many years? 5 years. See here. Same PVAF now. So for 5 years. Okay. Three point two nine. 3.29 is the annuity factor. Okay. At 15%, it is 3.35. It is 3.35, above 3.29. At 16%, it is 3.27, below 3.29. So at 15%, okay, we want 3.29, which is in the middle. Same like previous one only. Let us do. Okay. So PV at the rate of 15%. PV at the rate of 15%. Okay. For 1% change, .8% change is there. 0.08% change is there. So computation 3.29 and 3.29. Positive 0.06. Okay. %15.075. Okay. So for 1%, it changed this much. Okay. 15.075. So try to understand the calculation clearly. See here. For all of you, one last time I'm doing. At 15%, at 16%, okay. So 3.35 minus 3.29, .06. Previously I have written 0.08 na here. See here, for 1% change, value changes by 0.08. .75. So 15.75 is the answer. 15.75. So someone has given already 15.75 or 15.742, 743. Everything is right answer if you take 3 digits. Next, if I go from 16% point of view, the negative is there. Okay. .25. 15.75 is the answer. .74. 74 or 75, that is okay. Okay. Everybody understood this clearly? For the sake of your understanding, I have written. Okay. See this answer. Everyone, everyone understood computation? Okay. Now, one computation question finally for all of you. Do it. Illustration 11. Okay. What you have to do is illustration 11. You have to take illustration 11. Do it both NPV as well as IRR and tell which one is better. NPV is favoring which one, IRR is favoring which one you wanted to tell. You have to tell. Project X, project Y given. First calculate NPV. First calculate NPV. Taking the PV factor as 10%, calculate NPV for both. Once completed, next step what you need to do, you should tell which method is better as per NPV, which method is better as per IRR. Okay. Do it. 5 minutes time. Question came in exam already for 7 marks. Max 5 minutes time for a 7 marks question. That's it. Start doing.
Have you completed? NPV you can take directly 10%. While you do IRR, random numbers you have to take. I'm talking to you, everyone. Have you at least started doing? Tell what is the answer that you obtained, everyone. 10 minutes time I have given. Yeah. Beyond that, anyone can give that much time. This says 7 marks, 6 marks, 7 marks question. You should take max 8 to 10 minutes. Have you completed? Okay, see here first. I can't wait. See, look into the scenario first. There are two projects that are given. 10%. You can put 10%. Calculate PVCF for X, PVCF for Y, NPV completed. Correct? IRR means what to do? Rate we have to take. What we have to take? Rate. Such that the final rate you have to take is 2,50,000 in case of X, 3 lakh rupee in case of Y is the disco. Correct? Randomly put some number. Okay. For example, say I put 15%. Example, I also don't know na 15%. 1 divided by 1.15. Okay. 1 divided by 1.15, 0.87, 0.87, 8. 3 numbers came. I will multiply now. 2 lakh into 0.87, 1 lakh into 0.756, 50,000 into 0.658. It came to 2 lakh 82,500. 2 lakh 82,500. I got it 15. Okay, but the value is how much? 2 lakh 50,000. Our value is almost far away. Take 20% such that again value will reduce. I will take it 20. 1 divided by 1.2. One divided by 1.2. Okay, multiply 0.833 into 2 lakh, 0.694 into 1 lakh, 0.579 into 50,000. I got 2,64,950. 2,64,950. So one rate is 20%. At 20%, the answer is more than 2,50,000. You can take another rate as 25% or something like that. Here, see how much they have taken. Perfect. 20% they have taken here. Again, they have taken another percentage. Okay. 15% is something they have taken for project X and project Y. Finally, they got the answers. So X answer is 24.87. So they have taken 20% and 25. Answer came to 24.87. See. See here. First NPV calculation done. Okay, first NPV calculation we have to do. NPV calculation for 2 lakh, 1 lakh and all the other things we have done. This is the NPV. Everyone tell me, have you? So everyone tell me, have you got the NPV answer as 51,950 and 53,350? NPV of both X and Y. Have you got 51,950 and 53,350? Have you got the answer? Okay. After that, we have to take two rates now. I have randomly taken rates. Correct? At 15%, I got one answer. So I increased further. I made 20. At 20%, I got 264,950. That is higher than that of our investment. So I need to take rate higher than 20 such that value will become much lesser. So therefore, I have taken 25. At 25%, the answer is 2,49,600 and almost near to 2,50,000. So the answer is near to 25%. So answer came to 24.87. Same we have to do also with project number Y. See here. Finally, the answers came like this. NPV favored project X or project Y. Question will arise or not? Project X is giving a NPV of 51,950. Project Y is giving how much? 53,350. If you go by NPV, project Y is good. If you go by IRR, project X is good. Okay, project X is good. How to understand this? See, if your motto is to recover the cash flows faster, if your motto is to recover back the investment faster, if your motto is to not to see the bigger cash flows but the faster recovery, you go by project X. No, 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 sir. We don't want that run rate. We want consistency in playing it. Means what? Some players will have extreme run rate, but when they will become out, we don't know. Those are all IRR players. Those are all IRR players and the first 5 overs players. Some cricketers are there who stay consistent. Means what? They can come in first down or they can come as an opener. They will stand till the end. Their run rate will not be like, strike rate will not be like 103, 104. Strike rate decent, 60, 70 strike rate they will maintain, but they will stay till end and they will make century. Which kind of player do you want? We have to choose that first. Sir, I want power play player, sir. First flyovers, dhanadan they should hit. Okay, or last 5 hours they should come and hit. Go by project X. No, 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 sir. We want overall performance of a project, then go with project Y. Understood the point clearly? Everyone understood the explanation clearly? Yeah. Everyone, you have to answer. Okay, done. With this, as I promised, good time we spent on understanding IRR concept, different kinds of problems I made you to do. Okay, let us do one EAB EAC question. What question here? EAB EAC question. See. Let us see this question first. Okay. There are two projects, project A and project B. Project A is a 6-year project. Project B is a 3-year project. Okay. Project A is a 6-year project. Project B is a 3-year project. Okay. Now compare both of them. A person said you should tell first, are fool, we can't compare like that. Okay, first answer from your side. He will tell why I am a fool, because obviously a particular project which is having a 6-year cash flow will generally have more NPV. That's why NPV favored which project? Project A. Project A, bigger project when it comes to NPV. So when you go with IRR, this project is better because of faster recovery. Sir, what faster recovery, sir? Common sense again. Don't behave like a fool. See the numbers and understand. 40 lakh investment, 8 lakh is recovered in first year. And take calculator. 8 divided by 40 into 100. 20% is recovered in first year itself by project A. Now take 7 divided by 20 into 100. 35% is recovered in the first year itself. Means who is faster in recovery? Hey, our targeted runs are 400 runs we have to hit. Okay, how many runs here? 400 runs we have to hit. First over I hit 20 runs. Okay, or first over I hit 35 runs. Now tell me, who is very fast in recovering the number of runs? Means a 400 almost comparison of 400 here 200 70 200 runs. If I have to click the in the 200 runs, 70 runs initially only that fellow hit. So therefore there is a speed in recovery. So if you are seeing the speed in recovery, go by B. No, sir, I want overall cash flows, then go by project A. Everyone understood the point clearly? Hey, answer. But I want to select only one. Yeah, I wanted to select only one. If you want bigger cash flow, go by A. If you want faster recovery, go by B. Don't tell all these stories. I want to select only one among them. Tell me which one I need to select. Both are good. Okay, we will just a minute. Yeah. Hello. Class one mali chestam. So both are good projects only. Okay, but you can select anyone. No, I want only one. Tell me which is best one. In this case, you can't see NPV and tell A is better. You can't see IRR and tell B is better. It's a wrong comparison because A is seeing higher cash flow, B is seeing speed and recovery. Both are two different parameters. You cannot judge that way. Lives are indifferent. Lives are indifferent. Therefore, I can do two things. I can do how many things? Two things. What are the two things? B is a 3-year cash flow. B is a 3-year cash flow or not? A is a 6-year cash flow. Okay. What you can do? What you can do is repeat project B 2 times. Repeat project B 2 times, such that project B also will become 6-year cash flow, and then compare with A. But that become a labor work. Or do one thing. This 6 years, this 3 years, everything convert into 1 year average. So on an average, 1 year, how much they are giving? Let us see. Understood the point or not? So what we will do? We will discount all the cash flows of A. We will get discounted cash flow. We'll get what cash flow here? Discounted cash flow. Okay. Minus a discounted outflow if you take, you will get NPV. That is numerator. Divided by NPV is a discounted value. Correct? Because we apply discounting factors and calculate. Therefore, denominator directly don't divide it by 6, divided by discounted value of 6. Okay. So, what is the discounting factor here? 12%. 1 divided by 1.12 for 6 years. 1, 2, 3, 4, 5, 6. 4.111. 4.111. What is the NPV? 6,49,094. 6,49,094 divided by 4.111. Per annum NPV is 157,892. 157,892. This is per annum NPV. Per annum NPV. Okay. Next, other cash, other side. 5,15,488 divided by 1 divided by 1.12 for 3 years. 2.402. 5,15,488 divided by 2.402. 2,14,608. Okay. Now both are NPV, say, but NPV in per annum value. Okay. This is a 4.111 discounted year value. This is a 2.402 discounted life value. The numerator discounted values we have taken. This came per annum for 1,57,000. This came 2,14,000. Now tell me, from NPV point of view also, which project is better now? 2,14,608. Therefore, project B has to be selected. Everybody understood the concept clearly? See, 157, 854, 214, 608. 154, 157, 854. Or 898, it's a small difference. 214, 608. 214, 608. So project B should be selected. That's what we have. That's called as an equivalent annualized criterion, also called as equated annuity benefit. Annuity benefit. Last class we have an equated annuity cost. This is equated annuity benefit. Whenever lives of two projects are not same, immediately your mind should click NPV divided by PVAF. NPV divided by PVAF. Everybody understood? I'm talking to you, everyone understood? Okay. Next, capital rationing. What is the next one? Capital rationing. Sir, what do you mean by ration? Ration shops they tell now. What do you mean by ration? Limited resources are there, but needs are many. Allocation of limited resources among all the persons to their satisfaction is called as ration. Here, what is rationing? Capital is getting rationed. What do you mean by ration? Allocation of capital among different projects. is called as capital rationing. It's called as what rationing? Capital rationing. See, investment 50,000, NPV 15,400. What do you mean by NPV? After reducing this 50,000 out of some inflow, discounted inflow, you got 15. So I wanted to calculate that missing number. It is key. Tell me how much is it key? 65,400, 58,700, 35,100, 41,200, 54,300. What are all these? Discounted inflows. Discounted inflows. Okay. See, now I have 1,20,000. I have how much here? 1,20,000. Sorry. Now I will rank the projects on the basis of NPV. I will rank the projects on the basis of NPV. Okay. Listen. First rank, this one. Second rank, B. Third, fourth, fifth. This is the ranking. This is the ranking. Okay. Now, what is the first rank? 19,300 is the highest NPV. Therefore, rank 1 will go to whom? Project E. Project E. So, in your 1,20,000, first to put your money in Project E, 35,000 will go out. Okay? Wrong. This is not the way in which you have to do. Understood the point clearly? I will give you an example. I will give you what's the example. See here. See here, see here. Listen, listen. I will give you an example. Let us see this. C project. How much is the C project investment? 25,000 is the investment. How much? 25,000 is the investment in project C. How much NPV it will give? 10,100 NPV it will give. Okay. Now I will ask a question. How much E project will take? 35,000. Okay. How much NPV it will give? 19,300. I will ask a question. 25,000, if you give 10,100 return NPV, with the 35,000, how much you will give? 35,000 into 10,100 divided by 25,000. 14,140 I will give. How much? 14,140. 14,140. See, 35,000, 25,000 you have given how much? 10,100. 35,000 how much you have to give? You will give somewhere around 14,140. But project E with the 35,000, it is given 19,300 return. Correct or not? So in comparison with the C and E, if you tell, definitely I will tell E is better. Am I clear or not, everyone? Answer. Understood up to here? Okay. That's why whenever question comes on capital rationing for 1 rupee investment, who is better is a question there. So when I say for 1 rupee investment, it should not be in volume answer. It should be in 1 rupee answer. That's why PI will be calculated. Profitability index. PI, how to calculate? Disky by disco. Next. Next. Okay. Now see, what do you mean by this now? Ranking we will give. For 1 rupee investment, project A is giving 1.308. 1.308. In this, who is the best? E is the best one because with the 35,000, 19,000, it is giving the NPV. So here also rank 1 goes to E. Rank 1 goes to E. Okay. Next. After the next rank goes to B. Next rank goes to C. Next rank goes to D. Next rank goes to E. Now you observe first rank previously this same. Second rank also now and before same. But the third rank, if you see C, which is waste as per NPV, is in the top 3 in case of PI. Okay. So now I have how much with me? 1,20,000. How much? 1,20,000. Now listen carefully. Two assumptions will come. Project is a divisible project. Project is a indivisible project. What do you mean by divisible project? Divisible project means I can take up the project fully or I can take up the project also partly. Okay, I can take up the project also partly. See, I got a contract to construct buildings. Okay, if I have less capital now, instead of constructing 20 towers, I will construct only 15 and I will stop. Means I can even take up indivisible project. Oh, sorry, divisible project. Sometimes flyover constructions will be there. Okay, I can't tell I have only 100 crore with me. For up to half I will construct and I will leave remaining half we will construct. So in that case, that will not become a divisible one, that becomes indivisible. So question we need to understand whether it is a divisible or indivisible. If it is divisible, one way we will answer, indivisible another way we will answer. We will do both for this question. If it is divisible, means even part of the projects also you can take. I have 1,20,000. Rank 1 goes to whom? E. I will use 35,000 minus 35,000. Because of taking up E, I will get 19,300 NPV. Okay. Still I have 85,000 with me. Still I have 85,000 with me. Rank 2 goes to whom? Rank 2 goes to B. Minus 40,000. Minus 40,000. But I will get a NPV of how much? 18,700. I have only 45,000 now. I will now take up C. I will now take up what? C. C is how much? 25 minus 25,000. How much I will take? C project will give me NPV of how much? 10,100. Still I have how much? 20,000. In this 20,000, already E selected, B selected, C selected. D I need to select. D and L I need to select. D and L who got the better rank? 4th. Other D got the better rank, 4th rank. 30,000. But I have only 20,000. But I have only 20,000. Invest only 20. It's anyway divisible project. Na? So 20,000 divided by 30,000 means 0.066667. So in NPV also you will get only 11,200 into 0.066667. 7467 NPV I will get total. 7467 plus 10,100 plus 18,700 plus 19,300, 55,567 is the total NPV after rationing the project. Total 1,20,000 I invested. Up to here, everyone tell me understood or not? Everyone, we have to go a little faster here because we need to start with debtors management. Everyone understood up to here? Okay, done. Next. So now we calculated and we got 55,567 as the total NPV. Okay. Now, sir, no, sir. It is indivisible project. Then tell the answer. If it is indivisible, some part of the answer is same. Okay, some part of the answer is same. Means what? Projects are selected. Okay, projects are selected. Now listen carefully. I can select like this. I can select project E. I have 1,20,000 na? I can select the project E. When project is indivisible, try to put as much capital as you can. Maximum capital you utilize. You have to utilize maximum capital. I can do E. Okay? I can do E. I will do B. I will do C. Like now. E, B, C. Or B, C, E. 3 projects I will take. In that case, like previously, I will get 50, no. In that I will get EBC 19,300 plus 18,700 plus 10,100. I will get 48,100. This is which one? EBC combination. Okay. In that, how much will be invested? 35,000 plus 40,000 plus 25,000. So 1 lakh investment, you will get 48,100. This is one combination. Rendu combination. Okay, this is first one. Now second one, second combination. Obviously E I will take, obviously B I will take. Okay, instead of C, I will take A. I will take what? Yeah, A. Now tell me, how much I can invest now? How much I can invest? E. E require how much? 35,000. B require how much? 40,000 plus 50,000. 1 lakh 25. So I cannot carry on A because A require 50,000, which makes 1 lakh 25. I don't have that much. So A is ruled out. Next, C already I have done. Now I have option of doing D. D require 30,000. So now tell me, E require how much? 35,000 plus B require 40,000 plus C already done na D. 1 lakh 5,000. Further, what is the NPV that I will get? EBD 35,000, 40,000, 30,000, 1 lakh 5,000. You will get EBD NPV 19,300, 18,700, 11,200, 49,200. If the project is divisible, take E, B, C and part of D, some part of D. But if projects are indivisible, EBD is the best combination. 48,100, 49,200. 48,100, 49,200. They have given in thousands. That's it. If you know to do problem, answers automatically will come here. Everyone, please give a response. We completed capital rationing also. Understood or not? Let us see the presentation now. How to present this in exam. Two minutes time I will give. Read the notes on the screen carefully. Fast. Read fastly. See this question answer also. This is how you should present in exam. Presentation should be this way. Everyone understood? Completed? Done. So now we completed the discussion on capital budgeting chapter. Sir, everyone in the class, are you all confident with the capital budgeting chapter? Everyone? Okay? Yeah. So now your work is only to practice questions. At least take 10 questions, practice them. Take 10 questions. Take the question bank. So in my question bank, I kept the questions. Randomly pick 10 good questions. Start solving. Sir, I don't have any question bank. Best. Then do one thing. Take last 5 attempts, almost 6 RTPs you take. How many? 6 RTPs. RTPs, 6 RTPs you take, including this attempt RTP. So all these 6 RTPs, like capital budgeting questions you do. Over. Your work is done. Okay, your work is done. You need not do any other extra questions. Clear? Done. Next.